Fed shakeup. Gary Cohn is said to be the front runner to replace Yellen next year as the Fed chair gets ready to face Congress. Proceed with caution. UK unemployment hitting a 42-year low, but wage growth is weak. BOE's Ben Broadbent says he isn't ready to raise rates. And D.C. drama. Political uncertainty is back. Donald Trump Jr. and Russia stay in the spotlight as PIMCO warns the controversy could dim U.S. economic outlook.
Welcome to Bloomberg Daybreak on this Wednesday, July 12th. I'm David Weston, right here with Alex Steele. Jonathan Ferrer is off today. Alex.
Here's where we stand in the markets. It's about 2.5 hours until the cash open here in the U.S. S&P futures relatively flat, although on the highs of the session. Sterling getting a teeny bit of a boost. It was lower earlier. Then we got those solid job numbers out of the U.K. You do have some buying in the 10-year Treasury market. That's very interesting because we get $20 billion worth of supply later today. So see how the market handles that as yields move lower by 1 basis point. And crude getting a big relief rally here, up by over 1.5%. The EIA lowers its estimate for production here in the U.S. next year. But nonetheless, it just feels like a calm before potential more storms, David.
Maybe waiting for Yellen. So time now for the morning brief. And it is indeed a big day for the Federal Reserve. At 8:30 this morning Eastern time, we're going to get prepared remarks from Chair Yellen ahead of her much-anticipated semi-annual monetary policy report to the House Financial Services Committee. Yellen will appear in front of Congress at 10 a.m. to deliver those remarks and answer questions. We'll be watching for any indications on how fast they will raise rates or when they will start reducing the Fed's balance sheet. At 2 o'clock this afternoon, Chair Yellen's Fed will release its beige book. Then at 2:15 in the afternoon, we'll hear from Kansas City Fed President Esther George. She speaks in Denver on the economic outlook and the balance sheet. And with all the Fed news today, the drama of the Trump family's relationship with Russia will continue to play out down in Washington. Last night, Donald Trump Jr. went on Fox News to explain why his meeting with a Russian lawyer in an attempt to get negative information on Hillary Clinton's campaign was really no big deal.
I think it's a little bit ridiculous and overplayed, and I think people are getting that. I think the media has really done themselves a disservice by picking sides so flagrantly. They've really driven people to actually have to think about it because it's just a tough game.
Trump Jr. did say that he, quote, probably would have done things differently if he had it all to do over again. Joining us now is our chief Washington correspondent, Kevin Cirilli, who's on Capitol Hill. So was this a big deal or not, Kevin?
Well, lawmakers here on Capitol Hill think it was a big deal, David. And in fact, several Republicans that I spoke with yesterday, including House Freedom Caucus Chairman Mark Meadows, suggested that Special Counsel Robert Mueller should be looking into these emails as well as other conversations. Then there also have been increasing calls for Donald Trump Jr. as well as Jared Kushner and Paul Manafort, the campaign manager at the time, to testify publicly. Now, I spoke with the top Democrat on the Senate Intelligence Committee yesterday evening, Senator Mark Warner, a Democrat from Virginia, to try to make some sense of all of this. Take a listen to what he told me.
I've never seen an example where an agent of a foreign government, and no particular foreign government, a foreign government that's an adversary who has been massively trying to interfere in our elections, and that's been the consensus of the whole intelligence community, has reached out in this way, and then to have a campaign respond to it. Any legitimate campaign official would know you don't take this kind of help from a foreign adversary.
Now, while Federal Reserve Chairwoman Janet Yellen will testify today, we should also note that Christopher Wray, President Trump's nominee to replace now former FBI Director James Comey, will have his testimony before the Senate Judiciary Committee to be the FBI Director at the same time. And I'm hearing that he could face questions on the latest developments within the last 24 hours pertaining to these emails.
So Kevin, that's reaction up on Capitol Hill. What about out of the White House? What's the White House doing to handle the situation? And particularly, do we know what the president thinks about his son?
Well, two things. First and foremost, yesterday, White House Deputy Press Secretary Sarah Huckabee Sanders saying publicly that the president defends his son, saying that he is a quote-unquote high-quality person. Then the second point that I would raise is when you take a look at the president's Twitter account. Typically, we've seen in the past the president go after the U.S. intelligence community, whether it's now former Director Comey or others. But in this case, he has largely kept quiet in terms of tweeting about this controversy. He did tweet just before Don Jr. went on Sean Hannity's show last night. But aside from that, we haven't seen much. Now, it's 7 a.m. David, you know this. We've done this for several months. Who knows what he'll tweet this morning?
Well, we know you'll be there to cover. So thanks very much, Kevin. Appreciate it very much. Okay,
Thanks,
whether Donald Trump Jr. thinks his Russian meeting was a big deal or not, as we've just heard, people on Capitol Hill are taking it seriously. Here's a sample of what we heard yesterday from both Republicans and from Democrats.
Any legitimate campaign official would know you don't take this kind of help from a foreign adversary.
We cannot allow foreign governments to reach out to anybody's campaign and say, we'd like to help you. That is a non-starter.
But first of all, for Paul Manafort, the campaign manager, to let that happen, that's an inadequate campaign manager that can let that happen, I can assure you.
But I can say this, is interference in elections, whether it be Russians or the Chinese or anybody else, is inappropriate. And so we've got to get to the bottom of that.
Whatever the political fallout of the Trump Jr. emails and meeting, there's the underlying question of whether he broke any laws. And to help us sort out the law, we're joined by a man who was himself an independent counsel charged with investigating President Bill Clinton as part of the Whitewater investigation. Earlier, he had served as a federal prosecutor, and today he's a partner in the law firm of Thompson & Knight. Robert Ray is with us now on the set. Welcome to the program.
Thanks.
So, answer the question about if there were a law broken here, what would it have been?
Well, a little hard to figure that out at the moment, although there has, at least with regard to the meeting itself, it raises, as others have mentioned, the specter of whether or not you could consider what was being offered a form of an in-kind campaign contribution from a prohibited source, i.e. a foreign national.
Yeah, to be clear, as I understand, there's a criminal statute that makes it a crime for a foreign national to contribute to a U.S. campaign, political campaign.
Correct, and it's a felony, so it's serious.
And do we know, does the law tell us whether information as opposed to cash can be something of value? There's a contribution.
Well, technically the answer is that yes, it's not limited to cash, so therefore it would contemplate that it could also be an in-kind contribution. However, generally speaking, prosecutors have been careful and reluctant to prosecute cases based upon this sort of thing, information, because generally speaking, it's limited to the types of in-kind campaign contributions that would be deemed to be cash equivalents. For example, if somebody offered you office, you're a candidate for office, somebody offers you office space, that would be a prohibited campaign contribution, no different really than cash. Why? Because it's a cash equivalent. You can figure out what the fair market value is of the square footage of office space and say to yourself, well, wait a second, if a foreign national can't contribute a bundle of cash, a foreign national also can't contribute free office space. That would be a prohibited campaign contribution.
Right. So in this instance, Donald Trump Jr. says, and we have no reason to believe otherwise, that in fact he did not get value information, that he took the meeting, had the meeting, she showed up, she didn't give him anything. Does that take care of it from a prosecutor's point of view? Does that answer the question?
Well, it doesn't completely take care of it, obviously, if things had followed through. And, you know, again, part of the investigation, which you would expect Bob Mueller to investigate, is to look for evidence of collusion, not limited to just simply this meeting, but whether there was any follow-up. And it raises the question about whether or not possibly other violations of law may have occurred. More significantly, if this conduct continued and there was further contact by Russian nationals with the campaign through the election and into the transition, obviously you have more significant questions that arise relative to collusion, i.e., if there were promises made by the transition about what the administration would do once it took office in exchange for certain information, that would present obviously a very serious question under, as people have mentioned, the Logan Act, which prohibits foreign policy conducted by someone other than the current administration or the current president of the United States.
Robert, if you're a market participant and you don't know anything about the law necessarily, and you're making bets on what's going to happen in Washington, what's like the one headline we need to watch for?
Well, I think you have to begin to think about whether it is true, as Donald Trump Jr. contends, that this was it, and this was the full extent of his contact with Russian officials or people who have contacts or acting on behalf of Russian officials. I think you want to particularly focus on whether or not any of this sort of activity continued on to a more significant period of time, which is the period after the president-elect was elected. That would present, I think, a more serious question. This one, yes, you could draw out technically a case where the solicitation itself is a violation of law. It doesn't require a completed act, but I think it's probably fairly certain at this point, on the assumption that there's not more, that no responsible prosecutor would bring a case under those circumstances. So I don't think Donald Trump Jr. is in legal jeopardy, honestly. It obviously represents a political problem. I mean, he understands himself that it represents a political problem, or he wouldn't have said what he said already, which is, in retrospect, with the benefit of hindsight, perhaps I would have done something differently.
So finally, just give us a moment on process. Presumably Bob Mueller will be taking a look at this. There are reports that he will be looking into this.
Sure.
If, in fact, there were more there or he decided to proceed, how would it go? Would he go to a grand jury? How does that happen? What would be the next step?
People think about, grand juries as being, at the moment that there's anything there, you go immediately to a grand jury and air all this out, and sometimes you do. I suspect the first call will be made to lawyers for the participants in the meeting to say that investigators want to talk with those individuals. So that would include Paul Manafort, the president's son-in-law, the president's son. They may or may not agree to speak voluntarily with FBI agents. There may be some consideration given to whether or not to bring them before a grand jury. The lawyers then have to make a decision about whether their clients will assert the Fifth Amendment, much of which, obviously will happen behind closed doors, and the public won't see much in the way of a manifestation of what's actually going on. Then ultimately decisions are made by prosecutors, in this case Bob Mueller, about whether or not anyone should be charged. But remember, the charging decision isn't about technically drawing out a case. A responsible prosecutor doesn't bring a charge unless a prosecutor fully believes not that a grand jury would return an indictment, but that you had a good faith basis to believe that a case that should be prosecuted is prosecuted, and that you expect to be able to prove beyond a reasonable doubt to a jury unanimously that the person is guilty of a crime. Remember, we're talking about a federal felony here.
Right.
So though, you don't talk about that idly. I know a lot of people, in the fashion right now to talk about, it was a crime that was committed and we're going to just run off to the grand jury and bring a case, or that these are treasonable offenses and that, all the parade of horribles. That's not, how we conduct investigations. That's not how Bob Mueller will conduct this investigation. And it will take some time. This isn't going to happen tomorrow.
Right. Just the perspective we needed. Many thanks. It was really terrific. Former Whitewater Independent Counsel Robert Ray. Alex.
We do some breaking news regarding oil. So OPEC coming out and saying that demand for their crude in 2018 is going to be below what they're producing and also lower than 2017. Net, OPEC still pumping too much. Interestingly enough, oil really doesn't go anywhere on that news, still up by over 1% on the day. Watching that headline as we head into the open. Well, coming up, Bill Gavin, former FBI Assistant Director, will be joining us. Plus, Republican Congressman French Hill, House Financial Services Committee member, one of the members who will be asking Fed Chair Janet Yellen questions today, live from New York and Washington. This is Bloomberg. Markets care about political risk again. Here's how the Russia headlines played out yesterday. Stocks dipped, trading volume spiked when news broke. Then it recovered after Lyle Brainerd was speaking. But the controversy over Russia was enough for PIMCO CIO Dan Ivekson to raise the red flag on his economic outlook. He said, we're becoming a bit more cautious about the possibility of meaningful legislation. These types of distractions are just going to make it even more difficult to gain consensus. Well, joining us now, Neil Duane, Allianz Global Investors Global Strategist, and Josh Feynman, Deutsche Asset Chief Economist. Guys, great to see you. Thanks for being here.
Good morning.
Good to be here.
Josh, do you agree? Are we starting to see a dimmer U.S. economic outlook because of this?
Well, I was always a little skeptical about some of the more grandiose expectations that were being bandied about, particularly in the immediate aftermath of the election. But having said that, I don't think we should throw in the towel completely. I think there is still a better than even chance that we get something on the tax reform side before the end of the year. But again, I don't think it's going to be revolutionary. I don't think it's going to move the needle all that much.
What I'm trying to get a handle on, Neil, is what are the headlines that market participants care about?
Well, I think just to pick up on where we started, we've actually felt for the last 2 or 3 months that the headline narrative of a global synchronized economic period, we think that's over and has been over for some time. The US is stalling, and without any stimulus from anything that Trump can put together through the Washington swamp, we think the US is going to remain dull at best. The UK is clearly now headed for a recession. Japan is going nowhere. So we think this sort of general rising tide that has supported risk assets for the last 12 months, we think that's over. And certainly with China looking to be stable ahead of the party congress in November, we can't see anything coming from significant coming from there either. So we think it's as good as it gets economically at the moment.
So, Josh, clearly the equity markets, the risk assets, to use Neil's term, have been really buoyed. I mean, they really have done extremely well. What assumptions are there underlying, if any, about what goes on in Washington on those equity valuations?
I think there is an element in there that they've been anticipating something to come out of Washington, something, at least a corporate tax cut, something tax reformy. I think they have been scaling that back a little bit. I don't think they've jettisoned it completely, and I think that's right. I think there is still, as I said, a better than even chance that something gets done, simply because I think the Republicans will look at it and say, hey, if we don't get anything done this year at all, that's going to be tough to take back to the voters in 18. So I think that will concentrate minds and they'll get something done, but it's going to be, very pared back, not revolutionary.
Neil, it seems like your call is regardless of what happens out of D.C. So is it a buy treasuries, search for yield story too? I mean, how do you position for a turn that many are sort of positioned against?
Well, I think, the way we would look at it is for clients who are nervous of the headlines, the Russian, event, the threats around President Trump and his policies, we think the hunt for income is the safer way to play. So whether that's your own US high yield market or whether you move and take a bit more risk in Asian or emerging market debt, we think the markets have been quite consistent that that's where there are some returns. I think for equity investors, as I said the last time I was on here, we think the value's just outside the US. Just historically, the US market is now expensive. It's done well. It's rightly done well. The Fed fixed the banks. The economy's done a lot better than elsewhere. So we just think you should be looking at either Europe or Asia as a sort of relative value trade, if nothing else.
Sure, but you make the argument that if the global synchronized recovery is kind of rolling over, that was one of the reasons why many investors wanted to buy Europe in the first place, aside from valuation. So how do you factor that in?
Well, I factor in that basically Europe is about 5 years behind the US in terms of this economic cycle. It's taken them so long to fix the Eurozone banks and to get some policy traction with the ECB that I would argue the US and the UK are very late cycle and Europe is mid-cycle. So in theory it can continue to trundle on in a very European trundling type of fashion, GDP of 2% or something, whereas I think the US is now staring into is the recession in 18 or 19 or 20, but we know it's coming because this has been the weakest and longest economic expansion we've seen in the last 100 years.
Neil Duane of Allianz Global and Josh Feiman of Deutsche Asset and Wealth Management will both be staying with us.
You made Trundle work. How do you make Trundle work at like 7:20 in the morning?
That's impressive. That's impressive. No question about it. Okay, coming up, it's day one of Fed Chair Yellen's semi-annual monetary policy report to Congress. We'll be joined by Matthew Hornbach. He's Morgan Stanley head of global interest rate strategy. Live from New York, this is Bloomberg.
Bloomberg Daybreak. I'm Alex Steele. A little softer in the equity market, up but only slightly. You're also taking a look at Euro stocks rebounding off of the lowest level since April. In the other asset classes, though, I was watching sterling. Did get a bit earlier on some better employment data, although real wages was still weak. But now we're off the highs of the session. I wanted to highlight Euro pound as well. Did have a big break here, hit the highest of the year. Now a little bit off those levels as well. Watch yields here in the U.S. as we get hit with a lot of supply, and oil, my fave, up by almost 1.5%. Even though OPEC keeps pumping, I don't know, doesn't make any sense to me. Emma, help me with Bloomberg Business Flash.
Thanks, Alex. Let's get you caught up with those headlines. The Bank of Canada makes its latest interest rate decision today, and economists say Canada will likely be the first group of 7 country to join the U.S. in raising rates. An increase would be the first by the Bank of Canada since 2010. Investors are watching closely should it be a sign of tighter monetary policy globally. The European Union's chief Brexit negotiators set out tough conditions for Britain before the two sides can start looking at a future relationship.
We have published 9 EU position papers so far on the different issues. And the EU positions are clear. We now need to know the UK's position on each of these issues in order to make progress.
Barnier said Britain needs to make sufficient progress on citizens' rights, payment of the exit bill, and Irish border issues before trade talks can begin. And sales at Burberry topped estimates. Comp sales were up 4% ahead of projections of 2.5%. Burberry said its results were boosted by strength in mainland China. The UK led gains in Europe, while the Americas remained weak with a low single-digit decline. And that's your Bloomberg Business Flash. Alex.
Thank you so much, Emma. Taking a look at a pound, still around the highs of this session after reports showed that unemployment in the UK fell to a 42-year low. However, you did see some kind of issues with real wages. They did not rise because of inflation. And Bank of England Deputy Governor Ben Broadbent said he is not ready to support an increase in interest rates. So still with us to break it down is Neil Duane, Allianz Global Investors and Global Strategist, and Josh Feynman, Deutsche Bank Asset and Wealth Management Chief Economist. Josh, in the previous segment, Neil said, look, it's pretty clear UK is headed for a recession. Do you agree?
I don't know that it's so clear. I mean, they're struggling. Growth is slow. There's a lot of cloud of uncertainty about how the Brexit situation is going to work. That cloud's not going to lift anytime soon. I don't know about recession, but I think, continued sluggish growth.
Josh, why has it done so much better than most economists thought it would at this point? Because there were predictions they'd be in recession within 2 quarters or so.
Yeah, it's true. I think there were some folks who thought the Brexit thing was just going to be, a knife's edge or a cliff and things were going to fall off. But I think, people are sort of getting on with their lives. They know there's the Brexit thing is going to be a difficult negotiation. We're not going to have clarity on that for a while. I think it's inhibiting investment and spending to a certain extent. But I think people are also recognizing, it's not the end of the world. They're going to resolve this, and it's still a cloud, but it's not a disaster.
I like where a Brexit thing is now where we're at with that as well. Neil, unemployment tends to wind up lagging GDP, right? So sure, 42-year high headline looks awesome, low headline looks awesome, but what's your forecast?
Well, I suppose our forecast is probably in the next 18 months as we go through the Brexit negotiations. You could see at the margin that unemployment will start to rise again, simply because of the uncertainty that Josh has been talking about. But what I would say, really, is the UK's done very well in the short term because the UK consumer has borrowed and spent. Savings rates in the UK have now collapsed to the lowest level possible. And your headline, yes, there's now a wage squeeze. Inflation is rising because of the weakness of sterling post-Brexit. We think that will constrain the spending inside the UK. The UK consumers as financially illiterate as the US one. If money's cheap, they borrow and spend. They have now borrowed and spent. The Bank of England is worried about the amount of debt that's been put through the system in auto loans and all the other things that we've seen here in the US. So I question everything's been pulled forward in the UK. That's why I'm more nervous that we see a slowdown. Even if we get the government being more fiscally supportive, I still don't think in the next 18 months it's a good prognosis. In one word, Josh, do the Hawks or Doves win in the next BOE meeting?
I don't think they're going to raise rates. No, I just don't think in this environment they will.
All right, fair stuff. All right, Neil Duane of Allianz Global Investors and Josh Feynman of Deutsche Bank Asset and Wealth Management. Thanks so much, guys. We are sticking with us. Up next, we're going to talk the future of the Fed. Gary Cohn, as the head, will discuss.
This is Bloomberg. I'm David Weston. Well, Chair Janet Yellen of the Fed will be testifying today up in Capitol Hill. And now we're going to Kevin Cirilli up on the Hill with the man of the hour. Kevin.
Thanks, David. Yes, the man of the hour, House Financial Services Committee Chairman Jeb Hensarling. All right, we're just a couple of hours away from Fed Chair Janet Yellen testimony. What are you going to be asking her?
Well, I hope that we are on some type of track for policy normalization, because keeping rates too low too long was a huge contributing factor to our last financial crisis. I want to make sure it's not a contributing factor to the next. So we've seen rates creep upward. I think that gives the Fed a little bit more room to operate with their open market operations. I think this is a good thing. But we also have a balance sheet that's huge. The Fed's footprint in our economy is so huge, and that's troublesome. And the composition to have a lot of mortgage-backed securities. It's very worrisome to have a Fed that intervenes selectively in particular credit markets as opposed to a more holistic macroeconomic impact on our economy. So I want to ask her about what they are doing as far as winding down this balance sheet to get to a more normal policy rate and a more normal balance sheet.
And Mr. Chairman, this is something that you've pressed on for quite some time now in terms of Reserve trying to figure out a timeline for when this will all happen. The Federal Reserve has signaled that it will be by the end of the year, but how will you go about, I guess, pressing her for more of a concrete timeline?
Well, I ask the questions and I hope she answers. But, quite seriously, we need a monetary policy that is still less opaque than the one we have. What we need is for the Federal Reserve to set out what is their policy, what is the rules that they use, what are the variables, how do those variables react to each other? Because in some respects, I'm very happy to be being interviewed by you now, but there shouldn't be so much hanging upon the words of the Fed chairman. She herself has said that she hopes the wind down of the balance sheet essentially operates silently in the background. I would say all of monetary policy needs to be operating silently in the background, and that means people ought to be able to know what the Fed is going to do. It shouldn't be that the entire financial sector of America has to hang on every word of Chair Yellen, but unfortunately they do, and that's why these hearings are necessary, because there's not enough known about the monetary policy path of the Fed.
Also not a lot known about the future of Federal Reserve Chairwoman Janet Yellen herself. Have you heard anything about her job future?
No, I haven't. So, listen, that's the president's call. He's got a little while to make that call. I think, listen, I have a lot of respect for Chair Yellen. We don't agree on every single issue, but she's a very bright lady, a very capable public servant. But there's a lot of people who could serve well as Fed chair.
House Financial Services Committee Chairman Jeb Hemsterling, we know you have a meeting to get to, so we'll let you get to it. But thank you very much for coming on Bloomberg, and we'll talk to you after the hearing. Great. Thank you. Back to you, David.
Kevin, thanks so much. That was terrific to have him just before those hearings. As we've been mentioning, later this morning, Fed Chair Janet Yellen will begin her 2 days of testimony before Congress, and specifically in front of Jeb Hemsterling. And whether it's asked explicitly in these hearings or not, one of the questions in the air is the one that Kevin's really just asked, and that is whether she's going to be keeping her job when her term expires next February. Yesterday, Politico reported that it looks increasingly likely that President Trump will name his National Economic Council Director, Gary Cohn, to replace Dr. Yellen. Recently, we asked Mr. Cohn about this possibility.
You'll have to talk to Janet Yellen about monetary policy. That's her prerogative, and she's an independent agency of the government.
Do you favor her staying in that role?
Again, we're not at a time where we're going to even be thinking about that. Her term runs into next year, and Janet Yellen is running the Federal Reserve right now.
Would you want to?
Would I want to?
Yeah, they came to you and said, hey, Gary, would you want to do this? Would you?
I have a great job running the NEC right now. I get to come in and work in the White House every day. It's a dream come true job, working as an advisor to the president. I'm very happy.
That is Alex Steele cutting right to the core of the matter in advance. Well done, Alex. Joining us now is Bloomberg Intelligence chief U.S. economist Carl Riccadonna. Still with us is Neil Duane of Allianz Global Investors and Deutsche Asset and Wealth Management's Josh Feynman. So we want to talk about monetary policy, Carl, but we have to talk about Gary Cohn and what's going on with Janet Yellen. Will this be asked explicitly, or how will it affect, if at all, these hearings today?
It has been asked repeatedly in the post-meeting press conferences, and she has continually deferred her opinions on that matter. This is probably her last Humphrey Hawkins testimony as Fed chair, assuming her term ends in early February. So now is as good a time as ever to finally deliver her intentions, whether she wants to stay on for another term or not.
How much of a difference would Gary Cohn make as a practical matter? Do we have any sense of that?
I think that, President Trump has said he's a low interest rate guy, just like Janet Yellen. I think Cohn would be of a similar ilk, trying to support the administration by keeping an accommodative stance of monetary policy. Janet Yellen has taken a slight turn in a more hawkish direction as of late. So I don't think there'd be a huge disruption. Cohn may be a bigger dove than Yellen.
And then bigger dove than Yellen. Okay, interesting.
Yeah.
Oh, no, I've thought that before. But talk about doves. Lael Brainerd speaking yesterday, shocker, right? She was a dove. But here's what she said that I feel like got the market's attention, that the neutral level of the Fed funds rate is likely to remain close to zero in real terms over the medium term. If that is the case, we would not have much more additional work to do on moving to a neutral stance. Carl, how pervasive is that kind of opinion at the Fed?
Well, they're getting closer and closer to the neutral rate. I'll tell you the quotation that I thought was most interesting.
You calling me out?
That was a good quotation because she's suggesting neutral Fed funds is not too far from where the Fed currently stands. But also in the speech, she said most prominently the exchange rate may be more sensitive to the path of short-term rates than the balance sheet adjustment. So the Fed is now pivoting towards balance sheet policy because they have the belief whether it's correct or not, we'll see, right? This is all uncharted territory, that this would have less of an impact on the exchange rate, right? Back 2 or 3 years ago, when the dollar was dramatically appreciating, it was a contingent led by Governor Brainerd that was convincing Chair Yellen to hold off on the path of policy normalization. This is telling you, watch the exchange rate. If we have a big adjustment as the balance sheet program commences, this could significantly change the Fed's intentions with respect to policy normalization. They could have to scale back the QE exit, and they could also significantly pull back on the rate hikes. If you have a big move in the currency, that could push core inflation even lower still and really jeopardize what the Fed's doing. In the earlier segment, you said, well, how did the UK avoid recession post-Brexit? Major currency depreciation helped to support the economy. We could have exactly the opposite if we have significant dollar appreciation on the balance sheet unwind.
Josh, what do you think about that?
Well, it's true, but I don't know that we will. Actually, one of the interesting things is that, the Fed's raised rates 4 times, and actually overall financial conditions, equities, the dollar, credit spreads, and all that, haven't tightened at all. They've actually, remained quite, supportive. And that's the market is anticipating the balance sheet is going to start to roll off. So I don't think that's going to come as a surprise. So I don't suspect that when that happens that necessarily people are going to wake up and suddenly the dollar is going to soar on that. To the point of we've got a lower neutral interest rate, I think most people think that's true, and that is one of the factors that will likely limit how high the funds rate goes in this cycle. But it's also true that we've had 100 basis points of tightening and anticipations of the balance sheet, and it hasn't tightened financial conditions at all.
So Neil, I suspect that Janet Yellen's goal in just 2.5 hours from now is going to be not to make any news at all.
Yes.
Right? But let's assume she fails.
Dry.
Exactly. But let's assume she fails.
Way to sell it, guys. Tune in at 10 a.m.
If she were to make news, despite her desire, would it be by indicating more dovishness? Because the Fed has sort of said, we're going to hike, we're going to keep hiking, basically. That's where we're going. We're intent on that. Even when the inflation numbers softened a bit, they said, we're looking through those.
Yeah.
How would the markets react if she today said, well, we're starting to have some second thoughts?
If that was to happen, my guess would be the dollar would weaken. I think many people forget the dollar's overowned. We think on a fundamental basis the US dollar's about 20% overvalued. And so we think that a lot of people are looking maybe to move out of the dollar. And I think the money flows around the world have very much been governed by the ECB and the Bank of Japan quantitative easing. And any sign of tapering and more natural interest rates in, say, Europe would stop the huge flows we've seen into US assets, particularly treasuries and the high yield. So I think the Fed policy is one that we're interested in. I think you're absolutely right about the financial conditions. We therefore think the market's quite complacent. We think you could see more rate rises until the market gets the message that financial conditions are supposed to be tightening. The last thing I would add with our political hats on is I think there's also a trade-off. If you get Trump, or more Trump, you get more Yellen. I think they will use his fiscal stimulus as a way of getting rates to more of the neutral level faster. So again, I think for a lot of us, we're going to have to watch. We're Trump dependent as ever because we need to see the policy that he comes out with.
Well, the ramification over the last few weeks has been really interesting in the bond market. Take a look at the chart here. You're seeing the amount of bonds in the Bloomberg Barclays aggregate index that have negative yields. That's been falling. It's now about 14% of the overall index. Neil, what kind of trade do you put on to deal with that when it's not only the dollar, it's not only the Fed, it's also ECB? What's the play?
Well, I would say on a 6-month view, you want to be short the bund. It feels like
didn't work in the U.S. though.
No, it hasn't. But I think the U.S. is in a different perspective, a different position. There's no sign of the ECB actually raising rates or doing anything that isn't supportive for the European economy. The Fed is in a different position, and so I would also argue tactically there's huge redemptions from the government bond markets in July in Europe. So it's very odd that we've seen this huge setback in the Bund when in fact the governments aren't printing any bonds. So I would expect to see a bit of a rally in the Bund, but longer term, it feels like we're going to see the Bund start to head towards 1%.
Carl Riccardo, you've looked at these for many years now.
Right.
What is the proper role of Congress as they have Chair Yellen come before them? I mean, specifically, is it appropriate for them to say, you have a theory about what happens with wages, depending on employment? It doesn't seem to be working out. What's wrong with that, and why aren't you following
I think it's absolutely appropriate for them to be questioning Chair Yellen on these issues. Her obligation is to report back to Congress. She'll be speaking on behalf of the committee, so it is not necessarily her own personal views. But in the interview with Hensarling, he said Fed policy is opaque and we don't understand the path or the rules. I disagree heartily with those assessments. The Fed is telling us what they're doing over the next 3 years, what their intentions are. They have very clear mandates of full employment and price stability. So this is not an opaque Fed. It's just not a Fed that happens to be ascribing to a Taylor rule or some type of modified Taylor rule. And I think that's going to be a key component of Chair Yellen's remarks, which are released at 8:30 before she starts speaking at 10. Based on the monetary policy report, which was released last Friday, this is going to be a hearty defense of the Fed preserving and defending discretion and not simply hewing to some sort of automated policy response.
And part of the reason why some argue that you haven't seen that flattening in the last couple of weeks in the curve is because of that, because the front end is already baked in, because the Fed has been so transparent. Josh, what do you think about going forward, though? If you have quarrels in the Fed, if you get a Cohen, are we going to see a rules-based Fed, or, as Carl pointed out, still a dovish Fed?
Well, I don't think it's a question of rules versus dove. I think it's rules versus discretion, and I think the Fed will, I agree, absolutely, the Fed will, go to the mat to defend discretion, for sure.
Every cycle is different, so
absolutely.
You have to have the human element of discretion.
Absolutely, and to say that there's uncertainty about the Fed, well, of course, but there's uncertainty about the economy and how it's going to evolve. So you're never going to be able to remove that completely. But the Fed has been incredibly transparent in telling us what they intend to do if the economy evolves in the way that they expect. The economy doesn't always cooperate, but I don't think that's a lack of Fed transparency.
Nobody likes a boss, even if it's a rule. Right? Everyone wants discretion.
Well put.
Okay. Many thanks to Carl Riccadano of Bloomberg Intelligence, Neil Duane of Allianz Global Investors, and Josh Feiman of Deutsche Asset and Wealth Management will both be staying with us. Coming up, as we've been talking about, Fed Chair Yellen kicks off day one of her semi-annual monetary policy report to Congress. We're going to be joined by Republican Congressman French Hill, House Financial Services Committee member, one of the people who will be asking Chair Yellen the questions. And next, we're going to head out to Sun Valley. Doesn't that look nice? Where leaders in finance, politics, and technology gather for the Allen & Company annual conference. For all of our viewers worldwide, including those out in Sun Valley, Idaho, this is Bloomberg.
This is Bloomberg Daybreak. I'm Emma Chandra here in the Hewlett-Packard Enterprise Green Room. Coming up later today, Dara Khosrowshahi, the Expedia CEO. That's at 2:30 p.m. Eastern Time.
This is Bloomberg. I'm David Weston. Allen & Company's annual gathering of media moguls is getting underway in Sun Valley, Idaho. And our colleague, David Gura, is out there to mingle with the moguls. We go to him now out in Sun Valley, Idaho. Great to see you out there, even in the sort of chilly, cold, dark. So, David, tell us, first of all, who are you seeing out there? We want to know the bold-faced names. But secondly, what really are the themes that you expect to really be discussed at this conference?
Yeah, so you have a lot of people from media and technology. This is, as you know, fundamentally a media and technology conference. It's grown bigger over the years and brought in more sectors and companies into the mix. But look, we've had Mary Barra here of GM. We've seen leaders from Silicon Valley come as well, executives from smaller companies, bigger companies. The themes vary year by year. There's always a big focus on political risk and foreign policy. General David Petraeus is here, Ambassador Richard Haas of the Council on Foreign Relations. There's a focus on AI this year, a big focus on AI. I talked with Roni Abovitz of Magic Leap. He's here to talk about the future of AI. A lot of people we talked to yesterday as they arrived at the lodge said that's going to be something that all kinds of companies are going to be interested in going forward. And healthcare, as you might imagine, a big issue here. There are big executives from big health insurers here. The head of the Mayo Clinic, the head of the Cleveland Clinic, Toby Cosgrove, is here. And I took an opportunity yesterday to sit down with him to talk a bit about the GOP healthcare bill and the prospects for it getting passage in the Senate. And here's what he had to say.
First of all, I think the bill has to fail. And I think it will fail. And then I think we need to go back and address what the problems are.
Interestingly, David, what Dr. Cosgrove was saying is that there hasn't really been a conversation in Washington about policy. It's been entirely driven by politics. He's here to participate in a panel on the opioid crisis here in the U.S. This is a place where deals are hatched, deals are discussed, but it's also an opportunity for executives from across the spectrum of business to learn about other things, and he's hoping to get more people interested in solving that opioid crisis here in the U.S.
So whether Washington's going to really fix the healthcare thing or not, Washington really is a big player in a lot of these companies' businesses. When Donald Trump came to office, it was in part on the promise of deregulation. Do the people out there see that coming? What's their attitude toward regulation these days?
Yeah, I caught up with Ken Langone yesterday as he arrived. He said the president is doing what he said he'd do and doing it at the right pace. I spoke with Michael Eisner, formerly of Disney. He said that lighter regulation is a good and a bad thing. And I talked to David Zaslav, the head of Discovery Communications. He says that he sees the regulatory landscape, the burden of regulation becoming lighter. Here's what he had to say about that.
The overall focus is it looks like it's more likely to be lighter in the focus of how you handle antitrust, and so I think overall, if there's less regulation, it's more positive. So from that perspective, I think that it's likely to be a favorable environment for business here.
I was struck talking to people yesterday, David, that here 5-6 months into this administration's tenure in Washington, a lot of executives still saying they're taking a wait-and-see approach. They're cheered by what they've seen, but still there's a lot of uncertainty that exists.
So finally, David, one of the things that everybody's waiting for coming out of the Allen & Company conference is what big deals we announce. I have to say, a few years back, my company, Cap Cities, got bought by Michael Eisner and Disney at Allen & Company, essentially. So are there any deals kicking around out there?
Yeah, there's a lot of talk about content and who's going to be controlling content. David Zaslav, among others, talking about what the cable company, the telecom companies of the future are going to look like. I was struck by what he had to say about the long-term approach he's taken to content. Let's hear what he had to say about that.
More and more, you're going to see the big distributors trying to make a determination. Can they get exclusive content from program platforms, or do they need to buy?
CBS still very much front and center here at this conference. Les Moonves arrived yesterday. We asked him if there was any interest in CBS buying Lionsgate, the film studio. He said unequivocally no. So we'll continue to watch here what looks like it may be shaping up here at Sun Valley. David?
Okay. They always deny it before they do it, David, in my experience. Okay. Thanks very much to Bloomberg's David Gura. We're seeing you later in the program. Checking back in with you when you sit down with Oath CEO Tim Armstrong. We used to think of it as AOL, but now it's Oath. Still with us is Neil Duane of Allianz Global Investors and Josh Feinman of Deutsche Asset. So, Josh, let's turn to you and talk about deals and where you are right now on mergers and acquisitions, where the market is. Is this a particularly opportune time to put together some of these big deals?
Well, I mean, financial conditions are good. They're favorable, right? So from the macro perspective, they are. I don't get into the weeds in terms of the specific sectors, or companies, but I think the macro and financial environment is still, still okay.
Well, what I find really interesting, Neil, is that yesterday when we had sort of the Russia drama play out, you had stocks dip and then recover on Fed comments. We didn't see that happen with the dollar. It dipped and it stayed low. It's a little up today, but it has not yet recovered. What does that mean that the driver of the dollar is?
Well, as I said, I think a lot of the driving of the dollar is about the uncertainty around the politics, but also the fact that I think there are better stories emerging around the rest of the world. And I think
so it's an ECB story?
Yes, or I think it's a growth story outside the rest of the world. And I just think that at the margin, I think a lot of people own the dollar, and now marginal flows are moving to more attractive asset classes. To the M&A, though, I think the important thing is, even when you go back to the bid for Unilever, I think we're going to see a lot of US companies that have effectively been, their margins are at record highs. They can borrow almost for free in the markets. I think they're going to look around the world for assets to buy because they've generally underinvested in their own businesses. So I think you're going to look at the value trade. The dollar's strong. The PE ratios of the equity markets are high. They can buy a lot of cheap assets. So I would expect to see a lot of M&A come out of the US into the rest of the world.
But are they cheap assets? Are valuations, Josh, so high that it's not as attractive to go out and buy things right now?
Well, I think valuations in the U.S. are probably higher than they are in other parts of the world. So I agree. People may look to other parts of the world as value, or at least relative value.
Okay.
Good stuff, guys. Great to see you. Thank you so much for joining us. Neil Duane, Allianz Global Investors, Global Strategist, and Josh Feinman, Deutsche Asset and Wealth Management Chief Economist. Thank you for joining us. Exciting day playing out here in the markets. If you have a Bloomberg terminal, check out TV Go. You can watch us online. Click on our charts and graphics. Interact with us directly. Just go to TV Go on your terminal. If you missed anything of the conversations that we've had, you can go back, click on it, and rewatch. This is Bloomberg. U.S. equity futures marginally higher following European stocks higher. Here's some of the movers that we're paying attention to. European oil stocks, BP, Shell, Total, all slightly higher on the day. You do have some API inventory numbers that came out yesterday that were positive. We have the DOE numbers at 10:30 today. That could also be positive. Plus, the EIA says they're revising their U.S. shale outlook down for 2018. Potentially good for those European majors. Also, Burberry, that stock up over 2%. Here's a retail story that's actually not terrible. Q1 comp sales grew by 4%, high single digits in Europe, Middle East, as well as Asia. American sales, though, did decline ever so slightly. But nonetheless, and Morgan Stanley predicts a good quarter for leather goods. So a retail story that's not bad. That's my takeaway from Burberry. And talking about retail, you got Amazon. Prime Day sales set to be the biggest ever. Echo sales tripled from last year. Sales could reach $2 billion. That would be a 21% increase year on year. David, I gotta be honest though, I was on it last night and there was like a gallon of Elmer's glue that you could buy on Amazon Prime Day. And I was like, who needs what?
By the way, your 2-year-old would have a riot with a gallon of
Elmer's glue. Like,
yeah.
What are you gonna do with that? Anyway, well, coming up, Matt Hornback, Morgan Stanley's head of global interest rate strategy, will be joining us. And Bill Gavin, he's the former FBI assistant director. Much more coming up. This is Bloomberg. Fed shakeup. Gary Cohn is said to be the front runner to replace Yellen next year as the Fed chair gets ready to face Congress. Proceed with caution. UK unemployment hits a 42-year low, but wage growth, real wage growth, is weak. BOE's Ben Broadbent says he is not ready to raise rates. And D.C. drama. Political uncertainty is back. Donald Trump Jr. and Russia stay in the spotlight as PIMCO warns the controversy could dim the U.S. economic outlook.
Welcome to Bloomberg Daybreak on this Wednesday, July 12th. I'm David Weston, sitting alongside Alex Steele. Jonathan Ferro is off today. Alex.
Well, here's where we stand. Half an hour before the testimony is released from the Fed. S&P futures pretty much flat on the day. You have the pound, the second best performing G10 currency against the dollar, up 0.2% after you got that better UK data for employment as well as wages. You do have some buying in the bond market, which is interesting because we get $20 billion of 10-year supply later on today. So see how the market behaves as yields back down by about 1 basis point. And I don't get this, guys. Crude up over 1%, despite the fact that OPEC comes out and says we're still producing too much. But go figure. I say that's positioning, not fundamentals. But what do I know, David?
Yeah, what goes down sooner or later must come up. And it's gone down, goodness knows. So maybe that's it. Okay, time now for your morning brief. It's a big day today for the Federal Reserve. At 8:30 this morning, Eastern Time, we're going to get the prepared remarks from Chair Yellen ahead of her much-anticipated semi-annual monetary policy report to the House Financial Services Committee. Yellen will appear in front of Congress at 10 a.m. to deliver those remarks and to answer questions. We'll be watching for any indications on how fast they will raise rates or when they will start reducing the Fed's balance sheet. At 2 p.m. this afternoon, Chair Yellen's Fed will issue its beige book. Then at 2:15 in the afternoon, we'll hear from Kansas City Fed President Esther George when she speaks in Denver on the economic outlook and the balance sheet. But it's not only the Fed that we're going to be watching in D.C. today, as we continue to see the legal and political aftermath of Donald Trump Jr.'s revelations about how he came to meet with that Russian lawyer in the middle of the campaign. Last night, the president's son went on Fox News, where he said it was really much ado about nothing.
I think it's a little bit ridiculous and overplayed, and I think people are getting that. I think the media has really done themselves a disservice by picking sides so flagrantly. They've really driven people to actually have to think about it because it's just a tough game.
In the same interview, Donald Trump Jr. admitted that he might have done things a little differently if he had it all to do over again. Our chief Washington correspondent joins us now for a report on how big a deal this really is. Kevin Cirilli is back with us. So, Kevin, give us reactions from Capitol Hill, but maybe even more important, from the father of Donald Trump Jr., the President of the United States.
Well, David, the White House is standing by Donald Trump Jr. even after the interview last night. The president tweeted actually earlier this morning, "My son Donald did a good job last night. He was open, transparent, and innocent. This is the greatest witch hunt in political history. Sad." So clearly the White House doubling down. I'm hearing that they are about to try to flip the script, so to speak, and push back against Democrats and the relationship between the previous Obama administration and Russia. But there's no question that there are several questions, not just coming from Democrats, but even Republicans. There's this angst and there's this feeling of, let's get to the bottom of this. When will this drip, drip, drip of information finally stop? And that's the frustration as they look to work on their policy agenda.
So, Kevin, this is playing out in all sorts of investigations up on the Hill with the Senate Intelligence Committee, Bob Mueller's investigation, things like that. There's also some more immediate, perhaps practical effects that could happen. There is a bill, right, on sanctions, increasing the sanctions against Russia, been passed by the Senate. How might this affect the dynamics up on Capitol Hill for those sanctions?
Yeah, this is where we can get into the weeds. The Senate nearly unanimously passed this legislation, this increasing of Russia sanctions. Now it's in limbo, so to speak, in the House. The White House is trying to tweak it a bit, not necessarily, as Democrats are accusing, to get in line with Russia, but to tweak provisions that some folks in the energy sector have some issues with. That said, there is intense pressure, David, for the House to get some type of sanctions bill done, and Chairman Ed Royce is someone who is working very carefully on this. I spoke yesterday with House Freedom Caucus Chairman Mark Meadows about this. He's a member of the committee working on the sanctions bill. Take a listen to what he had to say about the timeline for sanctions.
I think the frustration is trying to make sure that we target those sanctions, and with the overwhelming vote that we saw in the Senate, I think you'll see an overwhelming vote here on the House floor in the coming days.
So a lot of pressure right now for the House of Representatives in the coming days, according to Chairman Meadows, to get something done.
Okay, Kevin Cirilli up on Capitol Hill, thank you so much. As Kevin just suggested, politicians from both sides of the aisle were quick to say how important they think the revelations about the president's son are. Here's a sample of what they had to say yesterday.
Any legitimate campaign official would know you don't take this kind of help from a foreign adversary.
We cannot allow foreign governments to reach out to anybody's campaign and say, we'd like to help you. That is a non-starter.
But first of all, for Paul Manafort, the campaign manager, to let that happen, that's an inadequate campaign manager that can let that happen, I can assure you.
But I can say this, is interference in elections, whether it be Russians or the Chinese or anybody else, is inappropriate. And so we've got to get to the bottom of that.
And the markets reacted yesterday as well, although they were bounded shortly after. The underlying question is whether this is simply drama or whether any laws may actually have been broken, and how we will learn the truth. With us now is a man who has conducted many important criminal investigations during his career. He is former FBI Assistant Director Bill Gavin, and he joins us today from Boston. Bill, welcome back to the program. Good to have you here.
Good morning, David. It's good to be here.
Okay, so put yourself back in your investigative role here. Now, in all likelihood, this will probably not go to the FBI. It will go to Bob Mueller. But the same idea. Given this information, what do you do with it? Do you investigate it at all? And if so, how do you go about investigating it?
I think probably right now, David, where you stand depends upon where you sit. But I'm sure that the information is information that Bob Mueller is going to have to do something with. The whole problem is right now it just has a horrible optic of not reporting this to begin with. We can say that it was only a 15-minute meeting, is what Donald Trump Jr. is saying. It was only a 15-minute meeting, and therefore he really didn't remember it because it didn't go anyplace. But by the same token, one would put a question mark up there and say, if it didn't go anyplace, but it was from a Russian attorney, there's all kinds of questions there. It may be totally innocent. Who the heck knows? He has released a lot of emails that are pertinent to the facts. But it should all go over to Bob Mueller so that he takes a careful look at it and see where it fits into this whole investigation.
As you say, Bill, as far as we know, he didn't actually get any useful information from this meeting with the Russian lawyer. But from your experience investigating things for the FBI, how does it work when somebody doesn't actually follow through on doing something that may be criminal, but has the intent of doing it, or talks with others, even conspires with others to do something, even though it doesn't come to fruition? How do you investigate that?
Well, it all depends upon, can you prove conspiracy? And I think in this particular case, there's a giant leap to go to reach the conspiracy side of things. And with actual violation of a law, you really have to be careful there. There are certain constrictions and there are certain things that have to be accomplished in order to show the violation occurred. So this is amorphous. It's a cloudy, messy affair right now that doesn't sound good, but it really has to be teased out to see what is in the details where the devil always resides.
And Bill, to go to another subject that's at least tangential relevant, there's a confirmation hearing that starts this morning on Capitol Hill into Christopher Wray, the man who's been nominated to replace James Comey as the director of the FBI. What will Congress be looking for? What should they be looking for as they question Mr. Wray?
I think based on what has happened with Jim Comey and the conflict that exists there between the president and the head of the FBI, and he fired him, what they're going to be looking for in Christopher Wray, they want a moderate person who doesn't stand up in the spotlight, who conducts the business of the greatest investigative organization in the world. I'm a little bit biased in saying that, but who conducts that business on a day-to-day basis and hopes that nobody really gets to know his name that well. That's what they're going to look for. And what's his temperament in the past? I'm sure they'll tease some of those things out as well. What has he said about somebody is eventually going to get into waterboarding or some darn thing like that. But they're going to see what his prosecutive temperament was, because he was Associate Attorney General on the criminal side of the House for prosecutions in the Department of Justice.
Yeah, and these initial returns out of Capitol Hill from congressmen, senators, have been favorable on his temperament and his expertise, his competence, his professionalism. But how does Congress reassure itself that he can be as independent as an FBI director needs to be, given what happened with his predecessor?
I don't think there's any, you can't ensure any of that. I think that just by looking at the individual, listening to his remarks, seeing what his temperament is, I think that in any case, all of these cases, David, you have to take a little bit of a chance on some of these things. But I think with Christopher Wray, you're not going to take much of a chance. I think he'll be an individual who will assume the role of director of the FBI and have the acceptance both outside with Congress and inside with the employees of the FBI as well.
Bill, thank you so very much. That's Bill Gavin. He's the former assistant director of the FBI, coming to us from Boston. Now, coming up, Republican Congressman French Hill. He's a member of the House Financial Services Committee, and he's going to be questioning Fed Chair Janet Yellen a short time from now. Live from New York and from Washington, this is Bloomberg.
This is Bloomberg Daybreak. I'm Emma Chandra with your Bloomberg Business Flash. OPEC is still pumping too much oil despite cutting output. That's the assessment of the cartel itself. The group says 2018 demand for its crude will fall below current production levels. Oil prices have slumped into a bear market and concern that the production cuts OPEC implemented at the beginning of this year aren't deep enough to clear a global glut. And Twitter has a new chief financial officer. He's Goldman Sachs veteran Ned Siegel. He's the second time the social media company has turned to an investment bank for an executive to help revive its fortunes. Siegel is due to start next month. He'll succeed Anthony Noto, who will remain chief operating officer. And that's your Bloomberg Business Flash. Alex.
Thank you so much, Emma. So markets finally paying attention to political risk in D.C. Here's how those Russia headlines unfolded on Tuesday. Stocks did take a sharp leg lower, falling to session lows as trading volume spiked, then recovered, but that was thanks to the Fed. Safe havens also caught a bid. You had 10-year Treasury yields moving lower. The VIX shot up. However, you had equities recover, but yields on the dollar did not. Well, joining us for more is Matt Hornback, Morgan Stanley head of global interest rate strategy, and Christy Mitchum, Wells Fargo Asset Management CEO. Christy, let's start with equities.
Sure.
What headlines do you decide to pay attention to, and which ones do you not, if you want to put a portfolio together?
Yeah, so I mean, I think the headlines around around Trump, they're probably a little bit more drama than they are real market impact. And I think that's why you really saw equity markets take that sort of immediate dip down, but then sort of gradually recover. And I think what was really being priced in there is sort of a rotation to what really matters, which is really today and Yellen's testimony, and then obviously towards the end of the week, earnings. So we're going to start kicking off really in earnest earnings season. And I think that's where stock pickers are really going to put most of their energy and intellect over the course of the next several weeks.
What's interesting, though, is that Neil Duane of Allianz was on earlier, and he sort of took the opposite view, more negative view. Here's what he had to say.
I think the US is now staring into is the recession in 18 or 19 or 20, but we know it's coming because this has been the weakest and longest economic expansion we've seen in the last 100 years.
So basically arguing that the dip was actually more on a fundamental basis, not necessarily on headlines. Matt, it seems like the dollar and yields would agree with that assessment. What's your take?
Well, the reality is that yields haven't really been moving all that much outside of a couple weeks over the, since Sintra. And so, look, I think what we're seeing here is that government bond yields settle into a nice range ahead of Yellen. One of the things that I paid attention to yesterday outside of the Trump headlines was some quotes from Philadelphia Fed President Harker talking a little bit about how inflation may start to weigh on his mind as we move into the end of the year. Remember, the Fed is still expected to hike rates in December, and if inflation doesn't start moving back to their 2% target, they're going to have a pretty healthy debate about that.
Christy, I wonder whether there's a short-term, long-term issue also with the headlines when it comes to the equity markets. In this sense, if you said, and this is just a hypothetical, let's suppose that the news about Donald Trump Jr. and Donald Trump reduced by 15%, the likelihood of tax reform coming this year. What kind of long-term effect might that have on equity markets, apart from what happens just on a day-to-day trading basis?
Yeah, I guess my view would be that I don't think equity markets are actually pricing in a lot of tax reform out of the Trump administration.
So you think it's basically zero now?
I think it's pretty close to zero now. I think what equity markets would like to see is obviously some movement on the debt ceiling. They'd also like to see basically an outline or a schematic of tax reform and at least tax reduction. But I don't think there's a lot built into the equity markets, which is, again, why I think the potential disruption of a reform initiative on the basis of the Donald Trump Jr. news is probably not that significant for markets.
So, Matthew, reconcile for me at least the difference between the equity markets that came right back, but as we showed in the graph, the dollar didn't. So what's going on in the foreign exchange rate that is not being reflected in the equity, or vice versa?
Well, again, I think if you look at what the reaction of government bonds yesterday, right, we sort of initially rallied on the headlines, we came back, and then we ground back lower towards lower yields. Look, the government bond market is waiting for Yellen. We've got about a 55% probability in the price of the market today for the December hike. And depending on what Yellen tells us today, that is what is going to end up moving government bond markets by and large. So we've had the move after Sintra. And now we're just waiting for the Fed to opine on what's going on.
So what is your forecast for a 10-year?
Into the end of the year, we have the 10-year just below 2.5%. That is a forecast I'm very comfortable with at this point. It's below consensus, but I think appropriately so.
So that means that the risk-free yield is still on, Christy, in your world?
Yeah, I think so. I mean, I think the trade is still on, that people are going to still look to equity markets to actually pick up yield.
Because a week ago, all of a sudden, the question was, is that trade off? Have we seen a re-rating in the sovereign bond market that now makes you not want to go buy high yield? Does it make you not want to go buy equities?
If what you're asking is, do I think we're going to see a large-scale move out of high yield, out of emerging markets? I don't think so. I mean, I think the market's going to calm a bit. And again, our expectation, very similar to yours, is that we're kind of range-bound. As it with respect to rates and also with respect to equities.
Matt, sorry, David, go ahead.
No, go ahead.
Matt, I was going to say, where does the bond market get its cue from? Is it in Europe? Is it Draghi? Is it Yellen?
Well, for the past 2 weeks, it certainly has been. But I think looking forward, most market participants, I think, generally understand what the ECB is about. There's a little bit more question about how the Bank of England will approach things. The Bank of Japan, of course, is way off in left field. They're the only central bank that's really pushed back against the rise that we've seen in government bond yields since Sintra. Look, the Fed is obviously going to be important. And if we don't get that hike at the end of the year, not what we're expecting, but if we don't get it, that will have a pretty big impact on government bond markets as well.
So Christy, when you talk about equities, how much of it is because money is cheap as opposed to people want to buy stuff? There are two very different things. One is a supply issue, one's a demand issue. Is the demand there globally or in the United States as opposed to just it's really easy to get cheap financing?
Well, I mean, I think this is a lot a supply issue, right? I mean, I think people are willing to move into equities because they have nowhere else to go.
Yeah.
And I guess my point is I don't really see that changing.
But the central banks basically are supporting the equity markets.
Well, they are. And that's why what is important to equity markets is how that trade actually gets unwound. How does the Fed actually go about shrinking its balance sheet? How do we begin to see recalibration playing out with the ECB? Those things are really important.
And we'll be discussing that in just the next few moments. Good stuff. Matt Hornback of Morgan Stanley and Christy Mitchum of Wells Fargo Asset Management. Both of you will be sticking with us. And next, we're going to talk the future of the Fed. Political reporting NEC Director Gary Cohn is leading candidate to replace Janet Yellen as Fed chair. I asked him if he'd be willing to do the job.
I have a great job running the NEC right now. I get to come in and work in the White House every day. It's a dream come true job, working as an advisor to the president. I'm very happy.
This is Bloomberg. I'm David Weston. Well, just about a little over an hour and a half from now, Chair Janet Yellen is going to be appearing before Congress to testify. And one of the questions is going to be, is she going to keep her job come February? Because there's a report in Politico now that maybe Gary Cohn is in line from the president to be nominated to replace Janet Yellen. We talked to Gary Cohn about the possibility, and my partner Alex Steele really pinned him down on the question of the moment.
You'll have to talk to Janet Yellen about monetary policy. That's her prerogative, and she's an independent agency of the government.
Would you favor her staying in that role?
Again, we're not at a time where we're going to even be thinking about that. Her term runs into next year, and Janet Yellen is running the Federal Reserve right now.
Would you want to?
Would I want to?
Yeah, if they came to you and said, hey, Gary, would you want to do this? Would you?
I have a great job running the NEC right now. I get to come in and work in the White House every day. It's a dream come true job, working as an advisor to the president. I'm very happy.
So there you have it. For those of you who remember him, the Mike Wallace of today, Alex Steele, pinning him down, an investigative journalist. There she is. Okay.
I totally got him to say something.
Here now with the latest on Janet Yellen, Gary Cohn, and perhaps as important, how the Fed now is looking at rate hikes, the balance sheet, and exchange rates is Bloomberg Intelligence Chief U.S. Economist Carl Riccadonna. So, Carl, take us into that delicate question about exactly what's going to drive the strength of the dollar.
Right. So, obviously, the dollar has significant feedback mechanisms into the economy. It's not just the export sector that's impacted. It's domestic production competing against a flood of cheap imports. It's U.S. workers competing against the cost of other foreign workers. So the dollar matters. This was a key factor when QE was initially launched. The dollar basically fell to a 3-decade low in trade-weighted terms. And each round of QE, in fact, the dollar was lower at the end of the round than it was at the start of the round. So yesterday we heard from Governor Brainerd, who was saying, well, the dollar is more sensitive to short-term interest rates than balance sheet policy. So as we pivot to balance sheet policy, maybe we can avoid some undue appreciation of the dollar. I'm not so sure that that will be the case. In fact, normally short-term interest rates are the main driver of the dollar. But if we look at what's been happening recently, we can in fact see that longer-term yields have been a bigger determinant than short-term yields. So there's what works in the long run and what works in theory, and there's what works at the moment. And I suspect that the Fed could be caught off guard, based on Governor Brainerd's comments, if we see a significantly stronger dollar once the balance sheet runoff commences.
Right. Well, and then let's look at that, because we have a chart that kind of shows the two divergence. So on the one hand, you have a chart that shows euro dollar and then the short-term differential. That's 2-year, right?
So here we use the 2-year yield differential between U.S. and German government securities versus the dollar-euro exchange rate. And it works reasonably well over the course of the last 8 years or so. But we can see this divergence on the far right-hand side. If we switch to the next chart, which shows the difference in 10-year yield differential, look how tightly they're aligned, right? That's telling you if the Fed is running off the balance sheet, potentially there could be a backup in yields. Now, some of the recent backup has been driven by what's happening in Germany and the Draghi taper tantrum, if you will. But if balance sheet runoff results in higher, longer-term yields, you'll see a stronger dollar as a result, and that's a significant drag on financial conditions and on the broader economy.
So, Matthew, is this correlation of the 10-year a coincidence, or is there something underlying that's driving this?
Well, look, I think the reality is that action on Fed balance sheet is inextricably linked with the rate policy itself. itself, right? Remember, the Fed said they're not going to start on the balance sheet until their rate normalization is well underway. So there's a timing linkage there, and I think that's primarily why we're seeing the long end of the curves dictate what's going on in currencies. Is because, again, before you get to the balance sheet, you had to get another rate hike in. You had another rate hike. We do the balance sheet in September, and the Fed will continue to hike rates. So the two are linked very closely.
And, of course, that's Matt Hornbuck of Morgan Stanley. Also, Christy Mitchum of Wells Fargo Asset Management CEO here as well. But, Matt, it seems like conventional wisdom is that we're going to see the balance sheet discussion unwind in September and the next hike in December. If what Carl's talking about is true and the balance sheet actually is going to have a much more dramatic impact on yields in the dollar, do we have to rethink the order that we're preparing for?
Well, from my perspective, I think a lot of the balance sheet wind down that the Fed is about to embark on is already in the price of government securities. You know, usually when the Fed hikes interest rates, the yield curve flattens. But since the middle of last year, what we haven't seen is the yield curve flatten. We've seen the yield curve steepen up a lot, and then it flattened back a lot. But on net, the yield curve is actually not flattened over the past 3 rate hikes. And bear in mind, the market's also pricing in half of the next one. So, in effect, we've had 3.5 rate hikes from the Fed, and the yield curve has not flattened.
And financial conditions haven't actually tightened.
Well, I guess I would push back a little bit on that. I know it's a popular narrative that financial conditions haven't tightened at all. But remember, financial conditions affect more than just growth. They also affect inflation. And what we have not seen in the United States is inflation. Why haven't we seen inflation? The dollar's 20% stronger than it was 3 years ago, and it's causing downward pressure on goods prices.
So, Christy, have financial conditions tightened or not? Because it is generally received wisdom they have not. And Matthew's saying maybe not so quickly.
Well, I mean, I don't think financial conditions have tightened to the point that it's really impacting, where we see equity markets going. So, I hear what you're saying in terms of a little bit of tightening being seen in the inflation numbers, but I just don't think it's substantive at this point.
But what about real rates? As we've seen them sort of creep up 60 basis points, it has been a move. I mean, at what point does that start to crimp?
Yeah, I mean, I think that's a very valid question. I don't think we really know the answer, and I think that's why it's so important that the Fed be so careful with this equation that we're talking about. How do they think about shrinking the balance sheet? How do they think about, really giving the market really good cues and signals for where they're going to go rate-wise?
Haven't they done that?
Well, they're giving some cues. We still don't know the start date.
So, is it July? Is it September?
Will they announce in July? Will they announce in September? Will the program start in October? And will they be able to stick to the program? And if we see this move in the dollar, the Fed is caught off guard, and that means they rethink interest rate policy for sure and possibly balance sheet policy.
And I think the commentary that we heard yesterday also created a little bit of sort of room and uncertainty in the marketplace, a little bit more dovish than what we would have thought looking at the minutes alone.
There's a growing camp that's questioning whether the interest rate prescription is appropriate given the balance sheet runoff. And remember, this is uncharted territory, so we can talk all we want about, in theory, what should happen. What matters is what happens in actuality, and it's a relative value trade, as you highlighted. If yields are higher on U.S. 10-year securities or on the U.S. yield curve, then there will be a global capital flow into the U.S. to chase that yield, and that results in a stronger dollar.
But Matthew, doesn't this go to the essence of this rule versus discretion with respect to monetary policy? It's fine to say we want more discretion, but the more discretion you have, the less predictability you have. And the more rules you have, the more predictability. We want to know exactly how it's working. For example, maybe we want the Fed to say we're going to alternate interest rate hikes and balance sheet runoff. We're going to go back and forth on them so we know exactly where you're going. But that limits them.
It absolutely does. And look, the funny thing is, I spend most of my time reading through Fed language, parsing words, trying to figure out the meaning of this and that. I still can't figure out the Fed half the time, right? So it's, the Fed is very transparent. The messaging, I think, could probably be more obvious to people who spend most of their day looking at the Fed. Right. But the reality is if they are bound to a rule, things are going to change pretty dramatically.
And any insight, maybe in the next 10 seconds, we'll see. Christy, Matt, and Carl, you guys are sticking with us. We're just about a few seconds away from Fed Chair Janet Yellen's testimony release at 8:30. Here's where we stack up on the markets. Pretty much flat across the board, although the bias to the upside. Michael McKee has Fed Chair Janet Yellen's testimony. Mike, break it down.
Well, you're going to have to wait until the Q&A, really, for any news. Janet Yellen's testimony, just over 5 pages, about as bland as it could possibly be. The economy is growing at a moderate pace so far this year, she says, picking up a little bit in the second quarter after a slow first quarter. Growth will continue to expand at a moderate pace in coming years, she says, creating more jobs and pushing inflation towards the Fed's 2% target. Inflation, when it will rise and by how much, is the one uncertainty for the Fed. It is higher than it was at this time last year, but lower than earlier this year. Speaking for her colleagues, Yellen blames a few unusual reductions in certain categories of prices that will hold down the calculations of the annual rate until they drop out. She doesn't elaborate, but in the past she's blamed falling oil and cell phone prices. So what does it all mean? Well, more gradual, in her words, rate increases until the Fed gets to a rate that neither constricts nor expands the economy. Where's that? She doesn't say, but it's not far from where we are right now. As for the balance sheet, nothing new. They expect to begin this year reducing the balance sheet by adjusting their caps, and they hope to reduce it not to an ultimate size that you can particularly tell, but it will be smaller than it is now, larger than it was at the beginning of the financial crisis. Fodder for discussion later. There is a defense of the Fed's aversion to monetary policy rules. She may get asked about that. Lots of rules, she says, the Fed consults, but no one rule gives you the answer. There is nothing on bank regulation or comings and goings from the Fed, including her own status. So bottom line is, until the Q&A, maybe, there's no reason to adjust your trading positions on the Fed, guys.
I got to say, Mike, as you're reading it, people are laughing around the table and joking. It's like a cocktail party here in the morning. Carl, though, you had some insight.
I'm not laughing, Alex.
Oh, he's not laughing. He's very serious. Carl's very serious.
Now I am, but I wasn't laughing.
Tell me.
Two things that I beg to differ with in the initial pass of the headlines here. One, she says, FOMC does not intend to use balance sheet as policy. This will have huge implications on policy. So I think that maybe that headline is parsing the issue of the balance sheet operating quietly in the background. I'm not so sure it will be quietly in the background. Time will tell if they're as gradual as they hope to be. And the other point is the Fed continuing to emphasize this notion of just a few factors driving inflation lower. We have no wage pressures in the economy, or very little wage pressures. Yes, the cell phone contract price war is a factor impacting inflation, and yes, drug prices are. But if we look through the details of the inflation data, it is not being run by just a couple of idiosyncratic factors, as the Fed's been highlighting it. You're seeing it across the board. You see it in goods prices. You're seeing some cooling or stabilization in rents. And if you look through CPI services, you see disinflation in an array of categories. So the Fed is missing the boat here, thinking that this is just a couple of factors. Now, I don't think we're heading into deflation unless we have a significant appreciation of the dollar, but I think that the Fed is going to reassess what's happening on the inflation front later this summer when they see it's not just a couple of factors and wage pressures still are not picking up.
I absolutely agree. There are measures of inflation that are designed to deal with idiosyncratic one-off prints. They're called trim means and they're called median measures. If you look at the median measures that are coming out of the Dallas Fed, if you look at the trim mean measures that are coming out of the Cleveland Fed, they are also going down. And it's not just base effects. So something else is going on here. I wish the Fed would pay attention.
Right. The Fed has missed its inflation mandate continually, and it's going to ramp up the pace of hiking while inflation is backsliding.
And let's get to equities and Christie. How disappointed are equities that we're not seeing more inflation? Because traditionally, companies like some inflation.
Yeah, listen, I think all else equal, we'd like to see a little bit of inflation, and I think I would agree. It's concerning to think about the Fed actually missing this trade on inflation, actually not putting enough emphasis on where the economy is from a lack of overheating perspective.
I just want to say that it seems like the markets are agreeing with all of you at this point. You're seeing futures jump up. You're seeing yields coming lower, the dollar coming lower on that. If you were going to be a dovish theme, that's exactly how it's playing out in the markets, David.
Exactly. So many thanks to Carl Riccadonna of Bloomberg Intelligence. Matthew Hornbach of Morgan Stanley and Wells Fargo Asset Management's Christie Mitchum will be staying with us. We're joined now by one of the members of the House Financial Services Committee who will be asking Chair Yellen questions about her testimony just under 90 minutes from now. He's Representative French Hill. He represents the 2nd District of Arkansas in the House of Representatives. And before coming to Congress, he was actually chairman of the board of a bank in Little Rock, Arkansas. He comes to us today from Capitol Hill. Welcome to the program, Mr. Representative. Thank you for being here.
Thanks, David.
So we just heard a summary of what the prepared remarks of Janet Yellen were, and it were characterized by and large, not entirely, but by and large, as being fairly banal, fairly neutral. You've seen these, I'm sure. Are you getting enough information from your point of view, from oversight, to understand what the Fed is doing?
Well, I think these are typical remarks submitted by a Fed chairman. The real work is done in the committee and questions and answers, as your panel described. I'm very interested to hear from Janet Yellen this relationship between raising short-term rates and shrinking the balance sheet. When she appeared before us before, she said that she would not shrink the balance sheet until she got the short-term rate up a little bit more, I think was the way she testified. She didn't identify how much more, to give herself more optionality in the level of short-term rates. But since then, Governor Powell has outlined how the balance sheet will shrink over time. So I think we ought to have discussion today between rate raising and the Fed's view on that and how they'll normalize the balance sheet and get it down as a percentage of our GDP.
So is it the appropriate role for you, as you see it, sitting in the House of Representatives, to really pin her down on what the timing will be on the balance sheet? I mean, will you get as specific as when are you going to start it?
Well, we'd like to know really the philosophy behind it. We'd like to know the time frame. Governor Powell outlined a basic time frame. But how is she going to go about it? How did they set the ratio between reductions in the Treasury portfolio and the reductions in the collateralized mortgage obligation? The CMBS type MBS part of the portfolio. So, this is where I'm a big believer that the Fed should be only buying treasuries. So when you allocate assets at the Fed to other asset classes like mortgage-backed securities, you're really doing credit allocation, which is not a neutral territory for the Fed. So I'd like to see the mix, and then I'd like to hear her say, will she limit the Fed in the future to a Treasuries-only policy when it comes to open market operations.
So, as I say, you served as the chair of a bank in Little Rock, so you know banking. As a representative now, are you more concerned about the rate and the level of interest rate increases or how they handle that balance sheet?
Well, for me, it's we want to see where the market is on rates and see what their rules-based process is for raising rates. But I think the big impact, one of the biggest questions in economic policy today around the world is how are we going to reduce this very large Fed balance sheet, some 24% of GDP, up from around 6% of GDP before the recession. To me, it's the biggest economic puzzle, and the policymakers at the Fed have never faced this challenge before. So I think Congress should perform its oversight operation in monitoring how that takes place.
And do you come into this, Mr. Representative, with a view about how they should be doing that? A general philosophy of what they should be doing, in particular, how it might affect the underlying economy?
Right. Well, first and foremost, I think Chairman Bernanke lowered rates to zero during the crisis. That's absolutely the right policy move for the Fed. He put liquidity in the market. They took a lot of extraordinary measures during the recession. As a banker, and a person engaged in the markets, I did not support QE1, QE3, the QEs because I felt it was distorting the price mechanism in our economy and actually getting into credit allocation, a role I don't believe the Fed should have.
Okay, many thanks to Representative French Hill of Arkansas.
Best wishes.
Thank you very much for being
David.
with us, Mr. Congressman. Alex, you have some breaking news, I think.
Yeah, here we're looking at Royal Bank of Scotland here, that stock jumping in London trading. Here's the deal. The bank is going to pay a $5.5 billion settlement to settle mortgage-backed security claims in the U.S. They did hold provisions of about $8.3 billion against those claims at the end of the first quarter. The incremental charge, about $196 million, is going to be recorded in the second quarter. So the cost is largely covered by what they set aside. They will pay the FHFA $5.5 billion. So that's settled. Sigh of relief. Stock up in London trading. All right, coming up in the next hour, Stuart Walther, BNP Paribas U.S. equity and derivatives, a strategist. He always gets in the weeds. We love that. And coming up in Sun Valley, Tim Armstrong, Oath CEO and former AOL CEO. This is Bloomberg.
This is Bloomberg Daybreak. I'm Emma Chandra, and this is the Hewlett-Packard Enterprise Green Room. Coming up in the next hour, Tim Armstrong, Oath CEO and former AOL CEO. That's at 9 a.m. Eastern. Now to your Bloomberg Business Flash. OPEC is still pumping too much oil despite cutting output. That's the assessment of the cartel itself. The group says 2018 demand for its crude will fall below current production levels. Oil prices have slumped into a bear market on concern that the production cuts OPEC implemented at the beginning of this year aren't deep enough to clear a global glut. Uber is trying to ease investors' concerns after a series of scandals that have hit the company. On a conference call with investors, Uber executives said gross bookings increased more than 10% last quarter, while losses continue to shrink. Uber's attorney also said a legal battle with Alphabet over self-driving car technology could be settled before a scheduled court date in October. And the European Union's chief Brexit negotiator has set out some tough conditions for Britain before the two sides can start looking at a future relationship.
We have published 9 EU position papers so far on the different issues. And the EU positions are clear. We now need to know the UK's position on each of these issues in order to make progress.
Barnier said Britain needs to make sufficient progress on citizens' rights, payment of the exit bill and Irish border issues ahead of any trade deal talks. And that's your Bloomberg Business Flash. Alex.
Thank you so much, Emma. I mean, the UK's got a lot of its plate here, okay? The pound at the highs of the session. You did have unemployment in the UK falling to a 42-year low, but you got real wages really crimped by inflation. Bank of England Deputy Governor Ben Broadbent said he is not ready to support an interest rate increase. So with us is Matt Hornback, Morgan Stanley Head of Global Interest Rate Strategy, and Christy Mitchum, Wells Fargo Asset Management CEO. Matt, how do you understand the BOE right now? It was a 5-3 decision, and then all of a sudden now you have a little hawkish, a little dovish rhetoric. What's your base case?
Well, we don't think they're going to be moving anytime soon, but, the market has obviously been caught a little bit off guard over the past month or so with the changing communications. We now have a market that's pricing more tighter policy in the future. And so from our perspective, it's not the time to be betting on a Bank of England rate increase at this point in time.
Christy, what about you? How is your base case for investing in UK?
Yeah, I mean, I think our base case would be exactly the same from a rate perspective. And I think a lot of that sort of, wiggle that you're getting from the BOE is a reflection of the fact that we really don't know exactly how Brexit is going to take shape. Fascinating to see the news this morning saying that the ECB is going to take a harder line. Obviously, May somewhat weakened by the coalition government, which I think does give the ECB the upper hand. So I think there's just a lot of uncertainty in terms of how it's going to play out.
Well, let's talk about sort of the central banks in UK and how it bleeds over into Europe as well. The premium between USTs and bunds has really been narrowing, right? Matt, what's the trade with that? How much more can it narrow, and how do you trade it?
Well, we like treasuries. The models that we're running and just our general outlook for rates into the end of the year suggests that you want to be looking to buy treasuries at these levels. They're attractive. Based on our forecast, the forwards are a little bit higher. So we like treasuries. Having said that, the ECB is pulling back. Right? We know the ECB is pulling back. We expect them to announce the beginning of a tapering in September to start early next year. The market is obviously buying into that story after the Sintra ECB forum. So, look, we don't like bunds necessarily. We much prefer treasuries, and that's how we're telling investors to position themselves.
So, Christy, when it comes to the UK specifically, if the issue is really writing a check to the EU to really make things go away, how much is the GDP of the UK being affected by this uncertainty?
Yeah, so I think
what's the
there's
check you could write? You could write a check that said, just take this money and we'll get the money back in the GDP.
Yeah, I think that's unlikely, in terms of how I think this is going to play out. I think it's very interesting when we think about really the bifurcation here. It's first divorce and then sort of negotiate, what the playbook looks like going forward. And I would say the playbook going forward probably has the biggest potential to impact the UK GDP and growth prospects, across the European Union.
And at the same time, you've got the growth across the channel.
You do.
The continent. And that's what I assume is driving your call on the bund.
That's right. We're seeing great growth data. We think the ECB is gradually going to remove stimulus. Again, they're not in a rush to the exit by any means.
But because of the growth, the ECB will feel more inclined to remove some of the stimulus.
Absolutely. Similar to what we've been hearing from the Fed for the past couple of months, we're also hearing similar tones with respect to inflation out of the ECB. Look, as long as growth is above trend, as long as the labor market continues to tighten, eventually inflation will show up. That's the bet that central bankers are making. I hope they're right, but it's a big risk to take.
Well, but the reflation trade in the U.S. was go long equities, go long dollar, and short treasuries, like kind of sort of paired out with the U.S. equities. Are you convinced that that trade will play out in Europe in that way?
Well, I think it has been playing out very effectively that way. I mean, if we
But
look
why
at
Europe
equity
and
markets.
not the U.S.? Like, why would that reflation trade play out across the pond?
Well, I would say because it really started from a very different place, right? So we had, European, economies really stalled for quite some time. For a long time, the U.S. was actually leading growth. So I do think we're in a little bit of a catch-up phase here. And I think you've seen that in equity markets. Look at the, returns of European equity markets so far this year relative to the U.S.
By peripheries, in a word?
We like owning peripheral debt here. That's what we've been recommending.
Guys, really great. Love to have you, both of you. Christy Mitchum of Wells Fargo Asset Management, Matt Hornback of Morgan Stanley. And if you have a Bloomberg terminal, you can check out TV Go. Watch us online, click on our charts and graphics, interact with us directly. And if you want to ask the guest a question, you can do so in this segment. This is Bloomberg.
This is Bloomberg. I'm David Weston. The CFPB has proposed a new regulation that would make sure consumers get to sue financial institutions in court and not be limited to private arbitration. The regulation would apply to much of the nation, affecting credit card transactions, brokerage relationships, and a host of other business relationships. Some have estimated the potential cost to the banks could run into the billions of dollars. Here to take us through the proposal and what it could mean is Joe Nacero, one of the deans, maybe the dean of business journalism and a Bloomberg View contributor. Welcome to the program. Great to have you, Joe.
Thanks for having me, but I don't know about the dean thing.
Well, okay. Well, if I say it has to be true, right?
Yeah, absolutely.
So, Joe, tell us about this regulation. Why are they doing this now?
Well, they're doing it now because regulations take a long time, honestly. And because the guy who runs the CFPB, Richard Cordray, the former Democratic Ohio Attorney General, is, kind of on a mission. And he is not going to be deterred by the Trump administration, even though they would love to get rid of him. So we'll get to that in a second. What it does, very simply, is it says banks, anybody who's regulated by this agency, cannot simply say our customers have to deal with us in private arbitration if they don't like, if something goes wrong, if they feel like they've gotten burned by a banker or so on, that they have the right to bring a class action lawsuit. And that is a big deal. I don't think it's a giant, I don't think it's billions and billions and billions, but it's something like the Wells Fargo situation. Right. A class action lawsuit that would have cost Wells Fargo a lot of money.
But isn't this something of a throwback? Because the whole tendency in litigation has been to permit more arbitration. I mean, for 30, 40, 50 years. It's to say you can have an alternative to court. Isn't this really a throwback to the 1950s?
It's more a throwback to the 1980s, I would say, when class action suits really hit their heights. But in this particular case, there was a lengthy series of stories in 2015 in the New York Times, which I think may have triggered some of this, that basically showed that most people, because of the sums involved, $1,500, $3,000, $4,000, they didn't arbitrate. They just gave up. And I think that may have spurred this. And although it is true that it's great to have an alternative to court, I think what the agency is saying is, the arbitration system is really, it's basically pro-bank. And the customer really doesn't have a good shot at it.
So take us into politics here. This is the CFPB is Elizabeth Warren's baby.
Right.
She really likes things like this a lot. She's very much in favor of this regulation. The administration's come in with at least being dubious about the very existence of the CFPB.
Absolutely true.
So how does this play out in Washington?
Right. So you got to remember that this is an agency that was created out of Dodd-Frank. And the whole thrust in Washington is to pare back, if not get rid of, much of Dodd-Frank. In addition, you have this guy running it, Richard Cordray, who Trump can't fire. He's in there for at least another year. It's not a kind of agency where it's a 5-person, commission. It's one guy, and he is just hell-bent on getting as much through as he can in the next year, and he's not going to let them. He's not going to resign or anything like that. So there are going to be congressional hearings about this. It's kind of going to be a mess once this goes in because the Republicans running Congress are really anti this agency and anti this rule.
What about that statute that says you can pull back regulations at the end of an administration? Could they invoke that to just sort of cancel the regulation?
They can, and they may well. And I think you're going to have a big fight over that. Yes, that administrative vehicle, which really hadn't been used much before this administration, has now become the go-to vehicle to pare back regulation. So I think there's a really good bet that could happen.
Who's leading the charge up on the Hill?
As always, on financial matters, Jeb Hensarling, the Republican from Texas who runs the House Financial Services Committee and is about as anti-CFPB as you can get.
Well, is there any possible backlash from constituents? Because you say, this is everybody. This is moms and pops. This is out in the hinterlands. Like $1,500 here, $1,500 there. Is there a possibility that they actually get this reversed, that they're going to have to pay a price back with their constituents?
I think it depends on whether the Democrats can make a big deal out of this. I don't think this is on the radar of most consumers, even most people who have bank accounts. If the Democrats could say, here's another great example of how the Trump administration is, stepping on the little guy and, once again doing the bidding of the big banks, I think it could be. But, there's so much else going on. You have to wonder if that would really be their top priority.
There are a few other things going on. I think that's fair. Okay, thanks to Jonas Hare. Really great to get you on.
Thank you very much.
Bloomberg View columnist. Alex.
Great stuff. All right, well, coming up, a conversation with Tim Armstrong, Oath CEO and former AOL CEO. We're going to go live to Sun Valley, Idaho for that. Is that live? Is the sun really up or is it still dark? It is live. The sun's coming up in Idaho. This is Bloomberg. Fed chair shows her dovish side. Janet Yellen is monitoring inflation. The 10-year yield falls below its 50-day moving average, all as Gary Cohn is said to be the frontrunner to replace her. And D.C. drama. Political uncertainty is back. Donald Trump Jr. and Russia stay in the spotlight as PIMCO warns the controversy could dim U.S. economic outlook. And proceed with caution. UK unemployment does hit a 42-year low, but real wage growth is weak. BOE's Ben Broadbent says he isn't ready to raise rates soon.
Welcome to Bloomberg Daybreak on this Wednesday, July 12th. I'm David Weston, here sitting alongside Alex Steele. Jonathan Farrow is off today, and we'll be headed to Sun Valley, Idaho in just a few minutes and hear from Oath CEO and former AOL CEO Tim Armstrong in a Bloomberg exclusive interview. But first, we're less than 30 minutes away now from the open, and Alex has a check of the markets. Alex.
This is what it looks like when doves cry a little bit. So you have S&P futures right around the highs of the session. The dollar lower, all turning lower after you had Fed Chair Janet Yellen's testimony released at 8:30, where it appeared to be a little bit more dovish than the market was expecting. You do have buying coming into the bond market despite a ton of supply coming online. Yields backing down by about 6 basis points. So significant buying happening there. And as the dollar gets a little weaker, crude gets another uptick. You have now oil up by 2%. But a really interesting move when you take a look at that, David, when it basically have a little bit more hawkishness out of the market, and the market reacts immediately. So the Fed very relevant as we head into her testimony and Q&A at 10 a.m.
Yeah, you can see it really dramatically, actually, on the long chart.
Fun stuff. All right, now let's get over to Abigail Doolittle, who is taking a look at some of the movers in the market. Abigail?
Morning, Alex. Well, we do have the shares of PayPal Holdings trading higher, popping higher in the pre-market on the news that PayPal users will be able to use PayPal to purchase both iPhone apps and iTunes Music using their PayPal account. This is available in both Canada and Mexico, currently soon in the U.S. But David Ritter, a Bloomberg intelligence analyst, he thinks that the pop is probably more psychological, less likely to impact numbers all that much. He thinks that Apple users probably already have a card stored. It is worth noting those shares are up more than 50% from the spin out from eBay about 2 years ago. Not so bad. Trading lower in the pre-market, Harley-Davidson is after Goldman lowered its second quarter retail sales estimate, citing channel checks. Now, this is a familiar theme. Back on June 23rd, UBS echoed similar sentiments, and before this drop, the shares were already down 10% year to date, so some bearish expectations there. And then finally, Fastenal, shares of the industrial and construction supply company, higher on a better than expected quarter, beating both top and bottom line. Both showed more than 10% year over year growth. The big surprise here, though, gross margins coming in much better than expected, Alex, and these shares right now, if they hold these gains, on pace for their best day since the election of last year. Pretty good.
All right, great stuff. Thanks so much, Abigail. Now for an update on what's making headlines outside of the business world. Emma Chandra's here with First Word News. Emma?
Thank you, Alex. The president's son, Donald Trump Jr., says he never told his father about a meeting he took last year with a person he was told was a Russian government lawyer with potentially damaging information on Hillary Clinton. Speaking on Fox News, he attacked the media's handling of the story.
I think it's a little bit ridiculous and overplayed, and I think people are getting that. I think the media has really done themselves a disservice by picking sides so flagrantly. They've really driven people to actually have to think about it, because it's just a tough game.
This morning, the president tweeted, "My son Donald Jr. did a good job last night. He was open, transparent and innocent. This is the greatest witch hunt in political history. Sad." Senate Majority Leader Mitch McConnell says he's ready to reveal his latest bill repealing much of President Barack Obama's healthcare law. Another top Republican says the measure will likely keep a pair of tax hikes on wealthier Americans that Obamacare imposed to help finance expanded coverage. McConnell says a new bill will be introduced tomorrow, and he'll begin trying to muscle it through the Senate next week. And RBS has agreed to pay $5.5 billion to settle claims regarding residential mortgage-backed securities in the U.S. RBS is one of 17 financial institutions settling claims filed by the Federal Housing Finance Agency and conservator of Fannie Mae and Freddie Mac. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Emma Chandra. This is Bloomberg. David.
Thanks so much, Emma. The Allen & Company Conference, known as the Billionaires Conference, is underway in Sun Valley, Idaho. Over the years, some pretty big deals have come together at Sun Valley, and that's where my colleague David Gura is now with a very special guest. David.
David, thanks very much. I'm here with the CEO of Oath. That's Tim Armstrong, former CEO of AOL, now this hybrid of AOL and the Yahoo assets. Great to have you with us, Sun Valley regular here. Let me ask you where things stand. The deal has been finalized. You've been traveling an awful lot. What does Oath look like now, and where do you see it headed?
Sure. So first, thanks for having us on again, and good to see you out here. Oath is, 50 brands. It has about 1 billion consumers a month that use those properties. It ranges from Yahoo to AOL to TechCrunch to HuffPost, plus all of our ad systems. We touch about 1 billion unique consumers every 24 hours with our video syndication business. So it's a significantly sized internet and mobile company that's global, and something that we're excited about. The deal closed a few weeks ago, and we've been bringing kind of those assets together underneath Oath. Oath is a brand that sits underneath our portfolio, so you can think of it as a B2B holding company for those consumer brands. And really what we're focused on is 3 super simple things. One is to build brands people love for their phones. 2 is to build platforms other companies love. So if you look at like the deal we did with the NFL or companies like Procter & Gamble, overall there's a lot of global companies that use our systems to help build brands. And the 3rd is to build a company that talent loves. And we have a big advantage there because, we have 1 billion consumers. We have a limited-sized company from an employee standpoint, so our employees can have a big impact. So we feel good about where we're situated right now, and now it's our job to make it a great company and really for the future. So that's what we're focused on right now.
As you sift through all of those Yahoo assets, are you finding any diamonds in the rough? I think of Tumblr, I think of Flickr. Are there things that are standing out that you are now discovering as you go through all of that?
Yeah, I think the first asset, which I think Marissa did a really great job of, is talent. So I think there's a lot of talented people at Yahoo. And the second thing is, I think on some of those assets, if you look at Tumblr or Flurry, or even things that people really know about, like Yahoo Finance or Yahoo Sports, there's a lot of assets within those assets that we're really excited about overall. So I think our teams are highly organized. We're in the process. I'm flying around globally to see all 12,000 team members in person. But at the same time, we have our executive team really honing the strategy down. And one of the things I'm excited about Sun Valley this week is to spend a lot of time with other CEOs, and Lowell McAdams and Marnie Walden from Verizon are here as well. So, I think we're going to spend a lot of time thinking about how do we innovate all the assets we have, with partners, and partnerships going to be an important part of our future.
As you're mixing and mingling here, are there things you'd like to add to the company? Are there deficits that you see in the company now that you could add onto your?
I think there's a few areas that we believe that we have strength in, that we could be a lot stronger in the next couple of years. One is in video. I think that as the world goes more and more mobile video, we happen to have assets that will work well there. The second piece is really in the advertising business. I think Google and Facebook have done an amazing job. I think Amazon's doing a good job in advertising. But we have a differentiated approach, and I think over the next year or two, you'll see us come out with there's a whole bunch of products that will come out that will be differentiated in those spaces. So I think those two spaces are big. And then the third is trusted content. Bloomberg, you guys do an unbelievable job of that. We're big investors in content, and I think what you hear the world saying right now is, look, we want a high level of transparency, trust. So you look at assets like the Huffington Post or TechCrunch or some of the other things that we have that are great content assets. We really want to build those out. And then you lean all the way forward in content. We have assets like Riot Studios, which is one of the hottest AR/VR companies on the planet, and we've put bigger and bigger investments into that studio capability. So, I don't know, if you zoom back and look at 2020 right now, you have an industry that 73% of digital advertising is going to be mobile. 80-90% of the traffic is going to be video on mobile. So we've been kind of building our assets against that base. And then we have super powerful human connections with people through our, we have great mail products and communication products. So we're in touch with consumers every single day. And the trick for us is to turn those touch points into a real, business opportunity to those billion consumers. And that, I think we have a clear plan and real focused team on it. And we're going to make all the merger changes we've been making and get through those. But, I think people really want to play offense inside the company, and that's a good sign.
Just ask you about regulation. There's a lot of focus on net neutrality today in particular. We've seen a lot of regulatory change in Washington. What does that landscape look like to you from your vantage now?
Yeah, I think, one is at a macro level for the industry. I think there's a lot of energy around making net neutrality work overall. I think when you zoom into Verizon's put out, William Johnson put out a really clear statement out of the company, which basically said, look, Verizon supports net neutrality. It's been penciled in. Congress should pass real laws around it and cement it. So I think that it's great. There's a day of action, that's been organized. And I think all of those things are really positive. And, the U.S. government and the companies involved and consumers involved have a real chance to, really cement a net neutrality situation that people like. And I think it'll go from kind of, something that was sort of crafted quickly years ago into something that will hopefully give the, country and our industry a big advantage if it's done correctly. And, I feel good about our stance on it. And all of our brands have their own stances on it, which I think everyone's leaning towards net neutrality. So that's the good news. And now it's up to Congress and the government to really make sure that it gets cemented.
Tim, great to see you again.
Good to see you again. And thanks
Tim
for
Armstrong, the CEO of Oath. David, back to you in New York.
Our very own David Gura. Thanks so much, David, from Sun Valley, Idaho. Coming up next, BNP Paribas U.S. equity and derivative strategist Stuart Warther. He reacts to yesterday's moves and the political pressure being put on the markets. Live from New York, this is Bloomberg.
Welcome back to Bloomberg Daybreak. I'm Alex Steele. The move this morning came from Fed Chair Janet Yellen's released testimony at 8:30. Here's how S&P futures wound up reacting. A jump higher as the Fed chair sounded a touch more dovish than the market had been expecting, saying that the central bank is on alert about prices remaining below the central bank's 2% target. In fact, in her list of concerns about the Fed outlook, the number one concern was inflation. Well, joining us now is Stuart Warther, BNP Paribas U.S. equity and derivatives strategist. So how do you where are we in the central bank Fed dilemma? Are we more hawkish now? Are we more dovish? Is Janet Yellen's testimony a game changer here?
I think what it does mean for markets, especially given the change in Treasury futures positioning from positive, as in long duration to short duration in the last few weeks, this essentially signals to the market that the Fed is not interested in increasing the market's pricing of the Fed until we see some pickup in inflation. So it really puts the onus on this Friday's CPI report, puts the onus on PPI on Thursday, and then also retail sales, because we really have yet to see any type of inflation pickup. However, other economic data, as we've seen in Economic Surprise, has picked up in the last few months.
And I feel like a debate is starting to brew of whether you're like a ratist or a balance sheet unwindist, and sort of which is going to impact the market more, which is going to impact the curve more, and which is going to impact FX more. Where do you stand?
So I think Brainerd pointed this out, and Rosengren's also pointed this out in the past, is that FX is most influenced by short end rates. So from that perspective, a change in the Fed's target rate is actually going to have potentially a more pronounced impact on FX and potentially more spillovers to other economies. However, if we look at the balance sheet, that is probably going to have a larger impact on the price of equities, as we've seen QE has had such an impact on the price of equities through the portfolio rebalance transmission mechanism. So I think from my perspective,
transmission mechanism 9:15, ding ding,
ding ding. I think from the perspective of equities, really the balance sheet is the juggernaut that we have yet to fully be able to price and comprehend.
Explain this to me. I'm a little confused this morning. On the one hand, we hear that the markets really don't believe what Janet Yellen's Fed's been telling them about, particularly what's going on in 2018, how many hikes are going to be. On the other hand, Janet Yellen just says, I'm a little bit concerned about inflation, and the markets react. So I understand, do they believe it or not believe it? Because if the markets really were discounting what she was having to say anyway about inflation, then they shouldn't be reacting.
I think this has been kind of throughout the history of the the post-financial crisis period. The market has always underpriced the Fed, and it has done so.
And the Fed capitulates.
And the Fed usually, exactly.
Yeah.
And so on this basis, the real kind of concern I think the Fed is having is about inflation, which is probably most likely to have an impact on their rate outlook as opposed to their balance sheet outlook. And even Brainerd, who is very dovish on the scale of dovish to hawkish, yesterday said that she would like to see balance sheet normalization happening soon, which would potentially keep July on the table, but probably likely a reference towards September.
But did you read Lael Brainerd as saying basically it's very different whether you raise rates or you release some of your balance sheet? That in fact we can do that without having nearly as much effect, for example, on the strength of the dollar. Mm-hmm. And so it's almost like a free shot to take some of the balance sheet off, but rates may be a different matter.
So I think there's something to do with the signaling effect, and if you tell the market it's not a big deal, hopefully it won't be a big deal, especially because it really is an unprecedented territory. No other major central bank has undergone such a significant tapering after such a long period. So they're setting up the market to not react. However, at the end of the day, we'll see where that goes. I think the key concern would be something like a taper tantrum, although if you look at the S&P overall, the impact wasn't that great. It was really on emerging market equities, on some of the growthier equities, not necessarily the large cap stocks in the U.S.
So what is the level on the 10-year that gets the search for yield to unwind?
I would say anything over 250. It keeps going lower and lower and lower. But really, we've seen the market becoming increasingly reactive to these changes, and it might not necessarily even be the level. Nominal GDP expectations have declined over the last 10 years, on a forward 10-year looking basis. So it's not necessarily an absolute level at this point. It's more of what's the next change in number of basis points that's going to cause equities to react.
I should point out yields dropping like a stone today. The 10-year yield now below that 50-day moving average at 2.3. So definitely a far cry there from 2.5. All right, Stuart Walther of BNP Paribas, thanks so much. You're going to be sticking with us. David?
Coming up later today on Bloomberg Markets, Alexis Ohanian, Reddit chairman and co-founder. Live from New York, this is Bloomberg. This is Bloomberg. I'm David Weston. Well, the drama that the Trump family's relationship with Russia has become has continued to play out in Washington. Last night, Donald Trump Jr. went on Fox News to explain why he thought his meeting with a Russian lawyer in an attempt to get negative information on Hillary Clinton's campaign was really, in the end, no big deal. At the same time, he did admit that he, quote, probably would have done things differently if he had it all to do over again. Joining us now is Chief Washington Correspondent Kevin Cirilli. He's up on Capitol Hill. So, Kevin, yesterday this was coming fast and furious. Take us through this morning. Are people more focused on Janet Yellen's testimony up there, and for that matter, the confirmation hearing of Mr. Wray, Christopher Wray, for FBI director, or is there further development on this Donald Trump Jr. story?
David, Republicans have largely been quiet on the fallout and the aftermath following the Donald Trump Jr. email release. The White House is defending him, but you haven't seen many Republicans speaking out forcefully in his favor, with the exception of saying that they need to get to the bottom of this. Now, the president has tweeted out since the last time we spoke an attack against Democrats regarding their relationship with the Russians. But I spoke with Senator Mark Warner, the top Democrat on the U.S. Senate Intelligence Committee, about the type of questions he would like Donald Trump Jr., Paul Manafort, and Jared Kushner to answer when and if they decide to publicly testify before his committee, before their committee. Take a listen to what he had to say.
Those questions are going to be, why was he so excited to, and why didn't he understand that having this kind of outreach from a Russian national who was acting and appeared on behalf of the Russian government to provide this kind of information to tear down Clinton and bring up his father? I think anyone, even if they were a rookie, would realize that was inappropriate.
And I think the bottom line, David, is that while the White House is urging that Republicans move on, Republicans on Capitol Hill are saying they're not criticizing Donald Trump Jr., but they're saying they need to get to the bottom of this.
Okay, many thanks to Kevin Cirilli down at Capitol Hill. So there was a lot of turmoil down in Washington and a little bit of turmoil in the markets yesterday.
Yeah, it was really interesting. You did the S&P come down, and then it wound up recovering its losses due to the Fed, but the 10-year yield and the dollar just kind of kept getting pummeled. Stuart Walther, BNP Paribas, U.S. equity and derivatives strategist, is still with us. How do you know which headlines to look at that come out of D.C.?
So it's really hard to tell. However, what we tend to look at is the immediate market reaction and really what it means for the probability of tax reform. And I think that's what the market was telling you yesterday. So we had the headline at 11:10 a.m. Regarding Russia, et cetera. S&P futures sold off dramatically, came back a little bit, but then it wasn't until McConnell announced that they would be breaking that recess for another 2 weeks that the market came back. And it's funny, with all the intraday volatility, the market actually ended up unchanged on the day. So zero vol when you're looking at close-to-close measure. But what's really the key thing related to, or really the key market driver for equities related to these developments is the implications for tax reform. So I think what's interesting is that what McConnell's release yesterday taught us is that the market believes ACA repeal is actually, if that happens, then tax reform. Now, a number of other commentators have said, actually, this is an impediment to the odds of tax reform because it's actually just delaying the legislative agenda. So I think that gave us a very interesting piece of information yesterday.
So if we do get a vote on health care, the next week or so or something, and it doesn't go through, and then you have Senate can actually move on to tax reform, or they'll say so, is that risk positive or is that risk negative?
So at this point, it's somewhat unclear, and I think it's unclear because we don't really know what the nature of tax reform will be. If it's revenue neutral, then actually that's not necessarily a positive for the S&P. If it is revenue neutral plus some type of repatriation, well, that's a rotation within equities to those companies with a high proportion of overseas cash. So I think we were of the assumption at some time earlier this year and last year, the market believed that tax reform was a positive for large cap equities. Now it's a little less clear, especially because the potential to actually induce more growth from a revenue-neutral reform is unlikely.
So in the meantime, what's an investor to do? I mean, particularly, for example, an investor in healthcare stocks. I mean, what do you do with all this going on? And then more broadly, as you say, like some of the large caps, some of the people who could really benefit from the tax cuts or reform. What do you do? What do you bake into your investment decisions?
Well, I think from the perspective of corporate boards, this may actually be a net negative, when we look back on this, in the sense that it's very difficult to do both investment and financial planning from a corporate level if you don't know what your tax code will be. Yeah. And it may be the same or it may be dramatically different. From the perspective of institutional investors, I think it's interesting to take a long-term view, but know that and in some ways markets suffer from a availability bias. You can only really price what is right in front of you or what is somewhat obvious. Some of these things, there's no way to price them, so you just have to ignore them in the meantime.
So then when you take a look at intraday rotation, when you have the intraday volatility, what kind of sector rotation do you see?
I think the key rotation has really been between financials, between healthcare, between also, related to the Fed, some of the more defensive sectors. So what's interesting is that, healthcare NASDAQ overall, so some of the growthier stocks, healthcare, tech, for instance, have exhibited very high volatility in recent weeks, and that's actually kind of driven some of the volatility in S&P. But as of last Friday, it was actually the defensive names.
Interesting. All right, Stuart Walther of BNP Paribas, you are sticking with us. We're 4 minutes until the open here in the U.S. You're seeing equity futures on the highs of the session as yields move lower, dollar moves lower, the Fed doves are out. This is Bloomberg. This is Bloomberg Daybreak. I'm Alex Steele. Just moments away from the opening bell. Here is where we're stacked up. It's a Yellen-induced rally. The Dow Jones futures up by 98 points. S&P futures up by almost half a point. NASDAQ, the best of the lot, up by 42 points. Had a more cautious Janet Yellen in her testimony, you could say, highlighting inflation as the #1 risk, saying that they will have to assess where it heads. That gets the market very excited. Take a look at what's happening in the bond market as well as the dollar. The dollar, now flat on the day. It had been moving lower, but you are continuing to see buying coming into the bond market. Yields down by 5 basis points now, so off of the lows of the session, but nonetheless a big move lower in the bond market. And crude kind of moving to its own drum, up by almost 2.5%, despite the fact that OPEC says on its own admission that it's producing more oil next year than it needs to. So let's see where stocks open now for trading. Abigail Doolittle has the latest. Hey, Abigail.
Hey, Alex. Well, the bulls are out on the open. We have the Dow, S&P 500, and the NASDAQ all solidly higher, up between 0.4% and 0.75%. The tech-heavy NASDAQ really leading the way. This, of course, being induced by that dovish commentary from Fed Chair Janet Yellen. In fact, Ben Emmons over at Intellectus Partners, he says this risk-on tone is also supported by other data, such as credit expansion in China. And all of this is acting as a bit of a shield to that D.C. drama around Trump Jr. So let's see how the day plays out. Helping these gains, of course, we do have some of the big oil companies trading higher. ExxonMobil, Chevron, ConocoPhillips, and Schlumberger all rallying. This was the top sector for the S&P 500 yesterday. Today, of course, we have oil higher once again ahead of the inventories report. On the year, though, this is one of the worst sectors. When we hop into the Bloomberg and take a look at #BTV2134, this is a year-to-date chart. In blue, we have oil down on pace for its worst year since 2015 and the oil crash. In white, we have the S&P 500 energy sector earnings estimates. We see that they're declining. The sector is expected to earn $15.10 in the second quarter. Amazingly, this was closer to $50 just a few years ago, so this decline is really the story. But check out that divergence between oil and earnings. It's going to be interesting to see as the earnings season gets underway, Alex, which way that solves.
Because everything has to do with oil. I keep telling you guys. Thanks so much, Abigail. Stuart Walther of BNP Paribas is joining us now, as well as Stephen DeSanctis, Jefferies, a small and mid-cap equities strategist. Jeff, I want to start with you because you're one of the firms that actually recently downgraded or to market weight from overweight in terms of energy stocks. Talk to us about the call.
Yeah, so you know what? I think this is a very humbling business where you kind of learn every day sort of where you go wrong and you get the scorecard here. But the upgrade in early March was the fact that we'd had a lot of interest in energy and the sector was down double digits year to date at that point. Still like there was sentiment, looked like our forecast of $60 on Brent, 57 on WTI was going to be met. And then obviously it shifted pretty dramatically and the sentiment's been really bad. And I think it's just one of those things where you just go to the sidelines because it's a group that, does have quite a bit of volatility, especially you go down cap. You're kind of dependent on global macro factors that don't go into the fundamentals. You have the chart of the revision trend. Well, that's not really driving it, right? It's all about sentiment and trying to figure out where people are lined up just gets a little bit more challenging. And so I think it was just a lot easier to go to the sideline and say, you know what, I could do better in other groups.
Yeah, and the small and mid cap getting hit even harder. I mean, Goldman Sachs made the distinction that IG names, investment grade names, are still adding rigs. Right. High yield has stopped, but the mom and pops have actually pulled back. So there is a tier rating to be made. What kind of oil price do you feel like is still embedded in market expectations for energy names?
Again, we have a great energy team led by Jason Gamble. Jason recently had a note out talking about oil prices and the potential for, a little bit more challenging to get to a target at the end of the year of $57, $60, depending on which one you're looking at. And so I think, again, it's not necessarily oil as opposed to the sentiment in the group. We continue to see outflows from ETFs. We still see no one wants to step up and own energy here. It's such a small part of the small cap benchmark. You make a good point on high yield. If you have a little bit of a pickup of high yield spread widening out, that's bad for the mom and pops because their balance sheets are still in correction mode. They're getting fixed. And so you still have the downside risk there for the smaller names to underperform the larger names.
Nonetheless, OPEC's chief is still pounding the table. He's still optimistic. OPEC Secretary General Mohammed Barkindo spoke earlier to Bloomberg.
The fundamentals at the moment continue to show us that we are on the right course, that we are on the path to achieving our objectives of drawing down stocks from these unsustainable high levels to the 5-year industry average.
Stuart, do you buy it?
It's not for me to decide, but I think if you look at dividend futures, which is a key derivative instrument that we follow, they have actually showed a slowdown in growth expectations, so the market is not buying it. And from that, I look earlier in the year when oil was rallying a bit. The 2018 versus 2017 implied growth rate was more than 8%. Now it's back below 7%. So on that basis, energy is a key contributor to the S&P's dividend. Over 10% of the dividend is from just the energy sector, even though it's only about 6% of market cap. So if you look at dividends underperforming the S&P broadly, which they have in the last 2 months, I think the market's telling you they don't buy it.
What we haven't had much of is volatility in the equity markets. If
or
volatility
oil,
comes back,
really.
Exactly.
Yeah.
But if volatility comes back, what is the likelihood it'll come actually out of energy, out of oil?
No, that's a good point. I think there are two key kind of fulcrum assets for the S&P. One is the tech sector. The other is energy. Now, from the tech sector, I think that's really central bank driven, but we can get into that later. From energy, at this point, above $40 a barrel in WTI, it's really both the direction and magnitude of the moves in energy that will potentially drive a spillover to the S&P. However, I don't think it'll become a systemic issue until we break down maybe another $3 to $5 a barrel.
So you've pulled back a bit, I think it's fair to say, in energy.
Yes.
Is there a point at which you come back in?
You know what? I've tried this for a number of years, and I've gotten burned each and every time that we've done that. Obviously, we got to start to think about also global demand, and you start talking about global GDP. Part of our story was around consumer driving more, drivers picking up, the economy's doing well, consumer wants to spend, they're getting in the cars, they're traveling more. And so with that, we're going to see a better demand balance, and we just haven't seen that kind of, play out. And again, you look at the fundamentals and revision numbers are coming down. You talk about balance sheets. I think valuations and just because the stocks are going down doesn't necessarily mean that that's a time to step up. And I've kind of learned my lesson at this point, I hope. I hope.
Jeff, broadening out to small caps in general, we've seen small caps rally over 5% in the second quarter. Are earnings going to live up to that kind of sentiment?
No. In the small cap space, earnings look to be down about 1.5%. So there's a big dichotomy between earnings growth between the larger companies and the smaller companies. And a lot of that is actually driven on the fact that the larger cap companies have the global exposure, and the global economy is doing better, have really driven the multinationals and their earnings growth. Small cap being a little bit more domestically oriented has not gotten that bump up. And so we've had a pretty big spread between earnings growth between large and small for the last 3 or 4 quarters. And that's going to continue here in the second quarter. And that drives our concern on small cap versus large cap and small cap in general.
And then same question for you, Stuart. In broader sense, will earnings match up valuation?
So I think there's, at least this quarter, something to do with a kind of narrowing of a spread that took place in Q1, which was the sense that, into what Stephen said, earnings from abroad, if you look at GDP earnings, were actually very strong, but overall, the actual S&P earnings did not match up with GDP earnings. So if you look at corporate earnings from the GDP report, those were very weak. S&P was very strong. This time around, you see that expectations are coming down, so roughly 6.5% year over year for S&P. And I think that if you look at valuations, they're based off 2017 and 2018 numbers that are still too high, at least when you're looking at the large caps.
One of the things that I keep asking is the relationship between growth and the underlying economy, GDP growth, and earnings growth. Because at some point, the money has to come from somewhere, either from the top line, which is presumably overall growth in the economy, or cutting costs. And there's a limit to how much you can cut costs. So if you're looking at projections for future earnings growth, how much do you look at what the GDP is doing?
Well, I think our chief economist, Paul Mortimer-Lee, was actually on surveillance this morning. He brought up a really interesting point.
Shameless plug.
Shameless plug. Related to earnings growth. And this is actually part of the issue I think we're seeing between unemployment and inflation in the U.S., which is that labor substitution, especially with multinationals, to foreign sources of labor, to lower cost sources of labor, has increased. Thus, I think without domestic GDP ramping up, we can still get that continued earnings growth.
Okay, Alex, we want to take a look at Washington just for a moment, because Christopher Wray, who's been nominated to be the next director of the FBI, is going to be just starting his hearings down there in front of the Senate Judiciary Committee. I don't remember a time when there's been this dramatic a situation for a new FBI director, given the fact that his predecessor, Jim Comey, was fired reportedly for not killing an investigation down there. And now, yesterday, on the eve of this, Alex, we have this revelation about the Donald Trump Jr. It's a lot of drama. Whether it amounts to anything or not, we'll see, but a lot of drama.
A lot of drama, and will that be reflected in the market? Stephen DeSantis of Jefferies, who I called Jeff like 4 times. I'm sorry, I have to have like 9 more cups of coffee.
You're plugging his company, that's all right.
Exactly, that's fine.
And Stuart Wather of BNP Paribas, you're sticking with us. Thanks, guys. I really appreciate it. Thank you very much. All right, here's where we're stacked up just about 10 minutes into the open. We do have a modest rally underway here in equities. You have the Dow up by 131 points, triple-digit rally, S&P up by 15, following the rally that we've seen over in Europe as well as in the FTSE, but also helped by less hawkish comments from Fed Chair Janet Yellen. Energy, real estate, utilities, industrials, all leading the S&P on the upside as oil also gets a pretty strong bid. This is Bloomberg.
This is Bloomberg Daybreak. I'm Emma Chandra here in the Hewlett-Packard Enterprise Green Room. Coming up later today, live from Sun Valley, Steve Paliuka, co-chairman of private equity house Bain Capital.
This is Bloomberg. I'm David Weston. The recent momentum in the market has been tied to tech, which meant a rocky few days last month when the NASDAQ 100 sold off. But now the momentum trade has reemerged and in full force. For more on the return of momentum, we're joined by Bloomberg's Danny Berger. Stuart Wather of BNP Paribas is still with us. So, Danny, explain this momentum trade and why it's been working right now.
Right. So, quick gist of momentum. It means that you bet on the stocks that have gone up the most in the past 12 months. So, as you mentioned, we had that tech sell-off. And of course, when you think of stocks that have done the best in the past 12 months, that is tech stocks. So trends have been pretty hard to find in the market when you look across the spectrum in assets. And the one place where we're seeing trend following doing very well is in equities. So momentum, when you look over the past 4 days since the July 4th holiday, it's done the best in over a year. So again, it's that strategy of going long the stocks that have done the best over the past 12 months and then shorting the stocks that have done the worst over the past 12 months.
It's not just buying the ones that are doing well, but it's also selling the ones that have not been doing so well.
Right. And so conveniently for these strategies, the ones that have not done the best over the past year, a lot of retailers. So Under Armour's on that list, Macy's on that list. So if you were short those stocks over the past couple days, you did pretty well. Again, that's just sort of a fluke. Like, you don't necessarily, when you do this strategy, pick specific companies. Again, you're just looking for the ones that have done the worst. It's an automated strategy. A lot of quants use this type of strategy in their portfolio somewhere.
I should point out the Dow rises to a new record closing high. So talking about momentum, Stuart, when you hear things like that, momentum trade back the last 4 days, Dow at another record closing high, what do you think?
Well, one thing's for sure, momentum and low volatility are two equity factors that historically have done well late in the investment and economic cycle. So I think that kind of makes sense from that perspective. One thing that we're actually looking at, and this is tied into the tech sector issue, is if you actually look at the tech sectors as in NASDAQ's own VIX, VXN index, and you look at the spread of that to VIX for the S&P, that spread over 5 points is the widest since before QE began. And I think that's really indicative of something that we put out last week, which was a note called overwriting growth, in the sense that if the Fed is potentially interested or concerned about asset valuations in the context of financial conditions, then the companies that have done the best, the momentum stocks, growth has been one of the best performing factors over the last few years. That will be hardest hit.
Well, how does that value growth trade play out in earnings? We get banks reporting on Friday. You can make an argument it's just financials versus tech at the same time.
So that's very fair. I think one thing's for sure, and if you look at that, what we mentioned before, Stephen mentioned, was that earnings estimates for the energy sector have gone down the most of any sector. Earnings estimates for tech over the last month have gone up the most of any sector. Nonetheless, if you look at value year to date, it's been an underperforming equity factor, but it has done well in the last few weeks. I think what Danny mentioned about the last few days is potentially indicative of something that we might see in the next week or so, but I still think the longer-term trend is for a little bit of a value rebound.
So, Dan, I'm curious just about the mechanics. You said since July 4, which hasn't been that long ago. They've been doing really well.
Right.
Momentum can change. It can turn around. How do you not get burned when it turns one way or the other?
Yeah, so this is certainly a quickly reversing strategy. So I do want to point out, Stuart mentioned that the NASDAQ 100 volatility index moving above the VIX. So one of the sort of theories of that tech sell-off we had, when you look at what stocks that sold off, they were pure momentum names. So a theory was floating out there that, hey, maybe a fund with momentum bets was unwinding. So something like that, to your point, it's easy to get hurt when you're in this sort of trade. But the thing is if you are in the middle of that and you decide, I'm going to cut risk, I'm going to do some sort of stop loss because my momentum trade is feeling pain, then you're going to miss the upside. You're going to miss the upside that we've had since July 4th. So I think a lot of it takes a strong stomach. And if you believe this late in the cycle, low vol, momentum, they're going to do well, then you kind of have to stick to it to see those gains out.
Really interesting conversation. Fascinating to see how it plays out over earnings season. Also, Bloomberg's Danny Berger, thank you very much. And Stuart Walther of BNP Paribas, you are sticking with us. If you have a Bloomberg terminal, check out TV Go. You can watch us online, click on our charts and graphics, interact with us directly. Just go to TV Go on your terminal. Feel free to go back, click on something if you missed it, and rewatch. This is Bloomberg. All right, earlier we got the release statement from Fed Chair Janet Yellen that she will deliver to the House Financial Committee in about 10 minutes' time. It was the shortest, I should say. It was just about a page and a half, and it offered no specific announcements on timing for the balance sheet's reduction, but it did offer some context on inflation, saying that stronger growth of incomes and jobs should increase resource utilization. somewhat further, thereby fostering a stronger pace of wage and price increases. Of course, considerable uncertainty always attends the economic outlook. There is, for example, uncertainty about when and how much inflation will respond to tightening resource utilization. Joining us now, Bloomberg Chief Economics and Policy Correspondent Michael McKee and Stuart Walther of BNP Paribas. Mike, it feels like the market took it as a more dovish Yellen. Is it, or is she just less dismissive of weaker inflation?
I think the market overdid it. This point, Janet Yellen just repeated what the Fed has been saying in just about every area for quite some time. People are pointing to that line about inflation uncertainty, but the Fed's been uncertain about the response of inflation. And they have said they're watching it closely. That was an issue at the last meeting, and they put that into the statement, which she repeated again today. Everything else, her assessment of the economy is almost word for word what we got out of the Fed's last statement. So no real changes in the statement. She came in trying to make no news and did a very good job of it.
Yeah, but it was interesting to see the uncertainty and sort of ranking them, right? It was inflation, fiscal policy, and then global economic challenges. What can we read about her list and what came first?
Well, inflation is obviously a concern for the Fed. It is supposed to be going up. It is not. The Fed view is that there are these unusual one-off circumstances like cell phone prices and, of course, the overhang of falling oil prices that's pushing down on inflation. And as those fade, we'll see prices move higher. Other people argue that, no, we're not seeing any kind of price pressure. There's been a secular change. But that's an argument that's not settled at the Fed yet. So they're keeping an eye on it. If we don't see a movement in inflation by the end of the year, maybe they hold off. But at this point, it's way too early to say.
In the meantime, the Dow touches an intraday record high. Oh, yet another high, Stuart. You're the market participant. What's the one thing you need to hear to stay really bullish on equities?
I think, well, I'll give you two things.
All right.
One, potential for a real meaningful and stimulative tax reform.
I meant from Janet Yellen in 10 minutes.
Oh, from Janet Yellen. Well,
yeah.
Then I'll give you one thing. I think she just needs to reaffirm that the Fed will be gradual, and the Fed is concerned about inflation with respect to its path of policy rate hikes, because what the market's most concerned about is the Fed potentially having a more hawkish than expected 2018 path of rates. And I think if she can put the quash on that, then the market will respond favorably.
So, Mike, you said when you first talked to us about this prepared remarks that there isn't a lot that's surprising in those prepared remarks. Take us into the questioning. Are the members on that Financial Services Committee going to be satisfied with, I don't know, I mean, we're going to do it gradually, whatever it is, but we're not sure exactly what we're doing? Are they going to press her? And in your experience, has Congress, by asking questions, ever really moved a Fed chair?
No, I don't think Congress has ever really moved a Fed chair. It's worked the other way around, and the prime example was when Alan Greenspan said we could afford tax cuts because we had a surplus. But really, nothing much comes out of these meetings. You get a lot of sound and fury, particularly on the House side where we are today, as members try to posture for the cameras and have some sort of clip of themselves talking to the Fed chair. Some members do pay attention to economics, and you could have the potential for some interesting questions about the neutral rate. Where is it? Why has it come down? What might push it higher? And how fast do you think you need to get there? Also, she did some preemptive comments on the idea of monetary policy rules. We know that we're going to have a new vice chair who favors monetary policy rules, and she could go into detail about why she thinks those don't work. And of course, David, I'm sure somebody will ask her about her own tenure, and I will expect her to respectfully decline to comment.
Yeah, exactly. Given that report out of Politico that maybe Gary Cohn might be in line for her job coming next February. So Stuart, is the real audience for what these questioners will be doing not Janet Yellen at all, but actually 1600 Pennsylvania Avenue? Is this reinforcing perhaps things like rules versus discretion? Things like, do we want Gary Cohn versus do we want Janet Yellen? Issues like that. Is that really what we're seeing today?
I think the issue of rules versus discretion, obviously the independence of the Fed is not necessarily something that is on the table yet. I think central bank independence is paramount, and it's unlikely to change anytime soon. But the idea of, what kind of questions these, members ask the chair could actually inform the White House's own view of economic policy and monetary policy, and see what types of things are important to the committee members.
Well, it's going to be a really fascinating Q&A. Really looking forward to it. Thank you so much, Bloomberg's Michael McKee and Stuart Walther of BNP. Great to spend time with you. Thank you very much. All right, so here's where we stack up. We're 25 minutes into the session. Here's where the markets stand. You have the Dow hitting an intraday record high. The S&P also on the front foot, up by 16 points. You also have the NASDAQ higher. The Russell actually hitting potentially a high, so watch those stocks as well. Europe and the FTSE still getting some kind of juice over there. That rally picking up steam to the upside, up over 1%. In the other asset classes, it is a story of a modest dollar. It was lower on Janet Yellen's testimony release. Now it's modestly higher, and the move in the bond market relatively similar. A lot of buying, yields down 6 basis points. Now some buying, yields just down by about 4 basis points. The 210 spread, that goes narrower as the day goes on, and oil just catching a huge bid, up over 2%. And we are 4 minutes away from Fed Chair Janet Yellen testifying before the House Financial Services Committee. You're looking at a live shot. Where is everybody? They're getting snacks. That's coming right up. Very good day to you. This is Bloomberg.